Mr. Michael Messina. Mr. Nicholas Hayes.
Here.
Thank you. Ms. Catherine Allen. And Mr. John Bingaman.
Present.
All right, thank you. A quorum is established. We have 2 members absent.
Jolene, could you go back to Mike?
Yes. Mike Messina?
Yes. Here.
Thank you. All right, so we have 1 member absent, and that's going to be Tim Jennings, and we have the governor absent.
All right,
Quorum is established.
Thank you. And it sounds like we have a quorum. Great. So with that, I'm going to move to the approval of agenda, and I'd like to request we have a motion by one of the members to move the voting items to the top because we've got a behemoth of a book today.
So moved.
All right.
Madam Chair.
Second. This is what it's going to look like. We have a motion by member Lavender, a second by member Summers. We're going to take agenda items 2, C, D, and E, and move them down till after our very last vote, which is under item 4. Okay, so 2, C, D, and E will be moved down after 4B. We're also going to take items 3D and K and move them down after items 2, C through D. Okay. What that does is basically after Vince's briefing, we're going to go straight into investment matters. Okay?
Madam Chair, for clarification on the second portion, D and K will go where?
After items 2, C, D, and E.
Thank you.
All right, any questions on that motion? Further questions? Okay, Jolene, we're going to take a roll call vote on that motion.
All right. Honorable Stephanie Garcia Richards?
Yes.
Okay. Honorable Laura Montoya?
Yes.
Thank you. Mr. Wayne Propp?
You have to leave for just a minute.
Oh, okay. Shall I continue? Okay. Mr. Harold Lavender?
Yes.
All right. Mr. Kurt Sommer?
Yes.
Okay. Mr. Michael Messina?
Yes.
And Mr. Nick Hayes?
Yes.
Ms. Catherine Allen?
Yes.
Ms. Catherine Allen? Okay. Mr. John Bingaman?
Yes.
Thank you. That is going to be 8 in favor.
Okay, great. And now we're going to move to agenda item 1C, which is approval of our minutes from the May meeting. We have a motion for approval.
So moved, Madam Chair. Second.
Okay, we have a proper second by member Lavender, second by member Summers. Any discussion on a motion to approve the May minutes? Hearing none, Jolene, if you could take a roll call vote.
All right. We have Commissioner Stephanie Garcia Richards.
I'm going to abstain because I was not present for that meeting.
Okay. Treasurer Laura Montoya.
Abstain?
Secretary Wayne Propp. Okay. We have Nick Hayes.
Could you repeat that?
Mr. Hayes, do you approve the minutes for the May 23rd meeting?
Yes, correct. Yes.
Ms. Catherine Allen? Ms. Catherine Allen?
Yes.
Mr. John Bingaman?
Yes.
Mr. Tim Jennings? Mr. Harold Lavender?
Yes.
Mr. Mike Messina?
Yes.
Mr. Kurt Sommer?
Yes.
All right, we have 6 in favor.
Let's move to agenda item 2A. I'm going to turn it over to our State Investment Officer, Mr. Moise.
Thank you, Commissioner. Good morning, everyone. I see on the screen that we are joined this morning by Mary Roman. Mary is a new advisory member to the State Investment Council Investment Committee. So welcome, Mary.
Thank you, Steve. Good morning, everyone.
Referring to the briefing that you have received, the May 2023 total distributions over the last 12 months to the state from the fund are $1,280,113,000. I'm rounding these numbers. The May 23 contributions from the state land office to the land grant permanent fund, which is lagged at 90 days, as most of you know, $192,197,000. The net asset value as of Friday, June 26th, $43,672,313,000. New Mexico WTI oil, price as of last Friday the 23rd, $66.77 per barrel. A year ago, that was $104.26, and the 29-cent premium to WTI was due to issues worldwide. The differential between WTI and New Mexico WTI is approximately $2.15 discount. For New Mexico, about $2.15 less than traditional WTI. Rig count in New Mexico as of Friday, 106 as opposed to 111 a year ago. And U.S. natural gas prices as of Friday, $2.73 per MCF compared to $6.24 a year ago. Any questions on those items?
Show me showing up at 9:15. It wasn't my fault.
Okay.
All right, thank you, Member Jennings. If you could also remember to mute.
I just got on the damn thing. Don't tell me to mute. It wasn't my fault.
Good to have you, Member Jennings.
Madam Commissioner, a couple of other things, if I may. I'm going to skip all of the items on the briefing which you received, except for this. I added something called Toward More Efficient and Productive SIC and CIC meetings. I added the words "and productive" just now. The SIC is an outlier in the manner in which we review and approve investments when compared to our peer funds, including ERB and PARA. Today's council meeting materials total 819 pages. The CIC meeting lasted over 4 hours. Vince and I are asking you to consider making our investment process more manageable. The changes I'm going to mention, and which Vince will comment on, are worthy of consideration, and they would allow the council to focus on matters which are very important and are considered to be best practices. So what are those items that we would like you to consider changing? No approvals of re-up investments. No manager presentations. No more council approval of individual investments. The use of consent agendas. Now that I have shocked a few of you, we will ask the governance committee to work with the investment committee to consider recommending to the council these or other changes. Harold and Vince have decided to not have consultants present today on individual investment voting items. However, the consultants will be available to respond to any questions. Thank you, Commissioner.
Any questions on those items? Hearing none, we will.
I do have a question.
Yes, Member Messina.
When are we anticipating voting on those issues? Next meeting?
After the governance committee and the investment committee are ready to make recommendations, whenever that might be.
Possible after that.
Whenever it might be.
Yeah, thank you.
Madam Chair,
Yes, Member,
those
Madam
four,
Chair.
Those 4 no approvals, can he mention them one more time? I got no more council approvals, no manager, and I didn't catch the rest.
No more council approval of re-ups.
And there were 2 others.
Treasurer, no approvals of re-ups, no manager presentations, no more council approvals of individual investments, and the use of consent agenda.
Thank you, Madam Chair.
So if folks want to discuss those further, maybe attend either the governance or investment committees, or you can even email questions to staff. All right, so with that, we're going to turn it over to our Chief Investment Officer for agenda item 2C.
Well, thank you, Madam Chair. Good morning, everybody. Very big agenda today. We're just going to bypass the normal macro briefing. Not a great deal has changed from our story so far this year. I'm missing a great deal there, I don't think. This agenda Steve mentioned agenda is large, 800 pages in your book, and it is large relative to agendas from the last 3 or 4 years. It's gigantic compared to your agendas from 5+ years. But assets are up, almost threefold in the last 10 years, and our asset allocations changed significantly also to more private market investments, which requires more of these individual fund investments that you see every month. And those 2 things are, conspiring for these big agendas. I've mentioned to you that our staffing has lagged, and we need an increased number of investors, and also accountants and support staff. And we will be bringing you a briefing on that this fall to talk about what our needs might be. We still have projections for these funds being perhaps $100 billion 10 years from now. We're really growing fast, and our infrastructure is lagging. So we'll bring you a report on that here this fall. Today, though, I wanted to just mention, Steve mentioned some things that you might want to consider doing less of or stopping altogether. But sometimes that raises the question in people's minds of, well, what will we be doing if we're not looking at all these investments and things? Let me tell you, just from today's agenda, or just from today's meeting, what you're not going to be able to do because we're spending the time on these individual investments. So today is the last month of what we call our macro package. So we always try to get all our macro stuff done between February and June. So here we are in the June meeting, we're at the last we're going to deliver to you the annual investment plan. As you know, that's not just a 1-year plan of what we intend to do, but it's a longer run view of both financial markets and the economy and so forth, and how we should be positioning. We take a 7 to 10 year view. The macro section of that plan is one of the important sections of it. We probably need an hour to 90 minutes to do that fully, inclusive of a demographics briefing that I did before the investment committee, which got just great reviews. In fact, I took their input after that briefing and approved it. Was hoping to do it here. We won't be doing that today. We've turned a corner in terms of the economic and investment environment that faces us, and we've made asset allocation changes to adjust. Those are big deals. We're going to cover that in 10 minutes today. That's the time we have on the agenda for the macro section. Kyle Kuznetsov, one of our strategists, has spent more than 2 years now constructing an investment risk management system, and today you're going to get to see your first report. And it's going to look like it's written in a language other than English. I can barely decipher the report. We probably need 30 minutes per meeting for a year to try to get folks comfortable with what's in that report and how you can use it in your oversight function. Kyle has 10 minutes today to cover your report. Nino Carpenino has constructed this extensive pacing model, which are how, where, and why we will deploy billions of investment dollars. It's something that many other funds aren't doing, and if they're doing it, they're not doing it at the level that Nino is with our pacing models. Nino's got 10 minutes to talk with you today about the pacing model. Our asset class directors have written firm plans on what they intend to do with their asset classes over the next year in the annual investment plan. We're not going to cover those at all except to answer questions for you that you might have after Lastly, today, we've got a report on intergenerational equity. It's a report we're really proud of. We developed it over the last several years. We've improved it over that time frame. And what that report does is tell you and tell us, the staff, and you as overseers, how well our funds are meeting their objectives, how well they'll be able to produce returns or produce outflows or distributions in the future in line with what we'd like to see. It's very good news in these reports today. Both land and severance have more than an 85% chance of maintaining their economic value into the distant future and providing benefits to those future generations as great or greater than today's generation. We got 10 minutes to cover that report with you today. Those are the kind of things that if we're not doing these manager individual investment approvals, those are the kind of things we can help you focus on. Those are the kind of things we can go through with you, make you feel better about, an understanding of what the macro and economic and investment market environment looks like, how funds are doing relative to what they're supposed to do in the long run. All the things we just mentioned, what's our risk profile and what kind of investment risks are we taking? All those things are what would be in substitute for looking at these individuals. So, and that's just from today's agenda. There's other things that we do throughout the year for the macro side, that have been on other agendas that we would do more of. So I just want to give you a feel for some of the things you would be doing if we weren't investment by investment, in terms of overseeing the plan and having a good feel for what's happening in the office. So that's my reading.
Move into agenda item 3. I'll turn it over to our investment.
Madam Chair, thank you. This is, these discussions that we're going to have about this process, I think is welcome, and with the agendas this size, it'll be very interesting. The investment committee meeting, as Steve indicated, lasted about over 4 hours on Tuesday a week ago, and we got it done, but it was challenging, and but I think that's what we signed up for, in my opinion, and that's okay. I think that Vince and I had a conversation yesterday about our presentations today because of the number of voting items, and this may kind of set the path for the future, but we're going to ask our asset class directors to cover each of the investments, and then the consultants and the funds themselves will be available to answer any questions that anyone might have. I think that's the idea of what we're going to try to experiment with today. If anybody has issues with anything or wants to ask questions, just please be clear so that we can know that that's where you're going. And please let us know to whom you want to address the question, because I think that that's going to be really helpful. But with having said that, Madam Chair, we can turn it over to item 3B.
Very good. And so we're going to look at our 2024 annual investment plan. And I don't know, Vince, if you've got comments on that, and then turn it over to RBC.
I do. So I'll be briefing this agenda item, and I'm trying to find the right page. Guys, there's two really important things we want to focus on here. Sorry, I should already have it.
Call out that page number, remember.
Okay, so let's go to page 231 of your materials.
Madam Chair,
Member Messina.
when you give these page numbers, that's diligent pages?
Yeah, so diligent page 231. So a couple of really important pieces out of the macro piece. First, we revised our growth forecasts for global growth, and particularly also here in the U.S. And unfortunately, that revision is downward. It's already been slow growth, and we've been forecasting that. I think it's our longest running theme that we're in a slow growth environment. within these annual investment plans. Today's, I think, the 12th iteration of these that we've done. It's going even lower. And it's really a function, one of the big functions is demographics. The age of the population continues to increase. And the economic system here in the world really is based around growth, and that's continuing to go down. And we walk through why that is, but a big component of that is demographics. And I'm hoping to take that, or to do that demographics presentation for you that we did for the investment committee, probably maybe October or November, which is about the first time we can do it. So we skip July. August is going to be loaded with investments, maybe because we're not take July, which we should. There'll probably be some spillover in September, so I'm hoping October and November I'll be able to bring that report to you. I think you'll find it really interesting. You'll find it as one of the big drivers as to why growth is going lower here in the world. We just need to be ready for it. We have to shift our portfolios and have to be in a lower growth environment. There's a whole bunch of factors in the report that I'm sure you've take a look at and we can talk about it if you have questions on it. So that's the first thing. That's the big change to this plan over the last few iterations of it. The second is we really think we have shifted into a new and different economic and investment environment than what we have been in. And that's on page 231. So if you look at the first bullet point on that, actually it's the first indented one. So for 25 years, from about 1982 through 2007, we had an economic and market environment that included falling interest rates, above average economic growth, disinflation, massive increases in per share corporate profits, rising equity markets, and other market multiples. It was a great time to be an investor. Most of my career was spent in that time frame. I came in 1987 as public fund investment officer, and it was fantastic. We could build portfolios that had lower levels of risk because we could own lots of bonds. Interest rates were very high. We could own stocks with confidence that earnings would come through, that multiples would continue to increase as interest rates fell. We could count on good returns from our bond portfolios. It was really a great time to be a public fund investor and to make those returns of 8, 9, 10% type returns for funds. That shifted when 2008, 2009 came, the great financial crisis. And we shifted into an environment then, dramatically falling growth rates, and that was sort of the front end of the demographic problem. And we talked about that a little bit with the investment committee. That period of 08, 09 also coincided with demographics really dropping off hard. It was a time of poor productivity growth, very low interest rates, low inflation. We had extreme monetary policy, 0% interest rates, QE, massive expansion of the money supply, and also fiscal policy. The U.S. government just on its own spent $16 trillion in deficit from June 2009 through September 2021. It was a lot. So we had extreme monetary policy, extreme fiscal policy, very low growth, falling productivity. Although financial markets responded to all that stimulus, and we still had okay returns, sort of 7-ish type returns, down from the 8, 9, and 10 that we were having previous, it really was built on these extreme sort of monetary policies, extreme multiples of things on our investments. We think we've turned that corner. We've seen the inflation come into the economy. We don't think the monetary authorities, the central banks around the world, are going to be able to hold those very, very loose monetary policies. We don't think governments, which are highly indebted now, particularly after the expenditures we had to make during COVID globally, very much in debt. We think their ability to continue to put that kind of debt or to borrow that kind of money to put it into the economy through fiscal policy, we don't think that exists anymore. We're in a new and different environment here, and we've changed our portfolios to reflect that. To a degree, you will approve some asset allocation changes that I think are really going to pay off for us in the future relative to other asset allocations that we could hold. But recognize that we think we're in a different environment. It won't look like it did over the last 10 years, and it won't look like that 25 years before that, for sure. So that means a lot of things So if you shift to, well, just at the bottom of that page, the same page, here's some of the things that we think we should be doing about it, and we've already been doing a lot of this. First, we think the U.S. will be better off in this next period than much of the rest of the world. In particular, we have the basics. We can feed ourselves here in the U.S. We can produce all the energy that we need to operate our economy. We've got an excellent geographic position in terms of two big oceans, protecting our country, at least from land or even sea invasion. We've got an excellent trading partner in Mexico, which has a great demographic profile. It's one of our largest trade partners. Not many others in the world have good demographic profiles like Mexico does. We've got a population that is not as quite as bad off as the rest of the world is. We have a millennial generation, and I know they get maligned, but they're a very large generation that most other countries don't have. Everybody's got a boomer generation. Most boomer generations did not produce a millennial generation. We did here. That's going to be very important for us, particularly 6, 7, 8, 9, 10 years down the road, as those millennials get further along in their economic lives. So we think the U.S. can be a little bit better off. So we think we should focus our investments primarily here in the U.S. Now, our publicly traded equity portfolios diversified internationally. We think that's correct. But in terms of our private investments, we do, and we think we should continue to have a U.S. focus. Now, it doesn't mean we shouldn't make any foreign investments in those portfolios. We do, we have, we do, and we should continue to do that. But we should focus that the U.S. may be better off in this next 7 to 10 year time frame that we cover with the annual investment, and put some focus on dollar-based domestic investments. The second point that I want to make, and I'll wrap it up here, is that we have projections of game-changing levels of inflows into these funds for the next decade. And it presents the council with a rare opportunity in public fund investing to build asset allocations into our growth funds that are aimed at maximizing the compounding of our returns. So in other words, those inflows that are coming in, we're projecting those to be enough to make the distribution every year, which means the investment earnings stay in the portfolio and compound. And as we've said before, it's been said that the eighth wonder of the world is compound interest. We have a tremendous chance to compound our returns in these funds and make these funds grow at a rate that other public funds just won't see. It's a tremendous opportunity for us. So we need to keep that in the back of our minds as we do our asset allocation, as we make investments, that we're looking for things that can compound returns, because we're going to get to let them stay in there and do that without the leakage of solutions with the great inflows that are coming in. That lets us take greater exposure to higher returning risk assets over lower returning assets that have to be in some of these other funds portfolios to help them manage their risks. It lets us have greater exposure to private market assets over publicly traded market assets, which gives us greater compounding power. And we would normally favor equity over credit for compounding power, but here in the near term, given our economic growth concerns, some of our concerns about valuations on equity markets, we think we still want to hold a good degree of credit, and we all approve the 15% allocation across our growth funds in our credit portfolio. So we think that would be a solid allocation. So with that, Madam Chair, that's the macro piece of the annual investment plan this year. And I'll take any questions that you like. We've got Dawn to give you just a few comments on the inflows. We think that's important for you to know. And Kyle will show you a few things on the risk report, just a few minutes on that. And then Dina will follow and show you just a couple of things in the piece.
Do you have questions for this?
Madam Chair.
Madam Treasurer.
Thank you, Madam Chair. I have a couple of questions and comments, and I know we're trying to be really respectful of time. So I'd like to mention them, and whatever you think we can talk about very quickly, or if we need to meet afterwards, I'd appreciate that as well. But I did read the packet and this particular reading material on the annual investment plan. It was really good reading. But some of the things that came to mind was there was a mention of volatility surrounding energy prices. And so I wanted to know how we factored that in. There was a recommendation of a reduction in safer, more stable assets, meaning core fixed income, and an increase in riskier, higher return seeking assets, specifically real estate and private equity. I remember about 2 months ago, I believe we approved the asset allocation at 12% for real estate, but there was a comment made on one of the pages that staff believes that valuation declines will likely overwhelm the NOI growth over the next year and most private real estate. So my question would be, is that something we need to factor in to change the 12% to a lower number? And then the last one was on the REITs actively managed, or are they tracking an index? And that was just a question I had because I wasn't too sure on either one of those.
Sure. So on question number one, let me let Dawn address that with her inflow analysis. That's a great question, and I'm sure she is confident to answer that one. On the risk assets over the bonds and other risk mitigating assets, the inflows are really helping us there. So normally you hold risk mitigating assets for two reasons. One is if you get a big equity market swoon, you have cash in place, or you have bonds in place that you can sell, so buy stocks when they're way down. We've got enough liquidity in the portfolio to do that, to defend against the big market swoons. The second reason you hold those assets are to make distributions, to have cash to make distributions, income to make distributions. That's covered. We think that's covered here in a quite long run over inflows or with inflows. So we think we're in good shape. We think we're in good shape to take a little more risk assets on. The last question on real estate. Yeah, in the short run here, we've seen some write-downs in the core real estate portfolio. That's cyclical. These plans are more secular, more longer term. So that just gives us an opportunity to increase or to buy into those asset classes at better prices. Those cyclical movements in the markets are generally welcome for a fund like that.
Other questions for Vince before we move into staff presentation?
Yeah, so we've got Dawn and Kyle both standing at all three to give just about 7 to 10 minutes on each of their areas.
Is it all right if we take all the presentations and then go to questions after that? Okay.
All right. Thank you, Madam Chair. Thank you, members of the council. I'm going to be starting on the inflows analysis of the investment plan. That's going to be on page 232 of your diligence book. And this section essentially describes the inflow projections that we had already presented to the council in April, very minor updates since then. So I'll just give us a brief recap of what it is that we're looking here. So last year, we all know we received over $8 billion in inflows across our funds, and that was largely due to a massive spike in oil and natural gas prices. For the land grant royalty collections, that means that those more than doubled. And then with higher prices and higher production, we saw that just tax and royalty collections in general in the state spiked up very high, and that triggered mechanisms that then transferred large amounts of funding into the severance tax fund and the early childhood fund. So if you look at the chart here on page 232, you see that huge spike there in 2022. And to call that, again, a record-breaking year is just a complete understatement. You can see the 20-year history prior to that, and we've never seen a year anywhere close to anything like that. Now, looking forward into the future, we are not expecting a repeat of 2022. You can see that in the chart going forward. But we are expecting inflows to continue to exceed those historical norms, and there are three primary reasons why. The first one is higher prices. Now, we've come down off of last year's high prices, that's true, but our $60 to $70 oil that we're experiencing right now is a lot different than the $40 to $50 oil that was averaging between 2015 and 2021. That makes a big difference for inflows. The second thing is production. The production in the state continues to grow, and it is expected to continue to grow through at least the end of this decade, and that's consistent with the forecast from most major energy research institutions. And then the third thing is that we're getting new sources of inflows, particularly for the severance tax permanent fund. That's going to be those yellow bars on this chart. If you look at the history of those yellow bars, and then you look at the forward projection of those yellow bars, very, very different. Large amounts of inflows coming into the severance tax fund because of the passage of brand new legislation in Senate Bill 26 that is expected to send billions into that fund into the next 10 to 15 years if these oil and gas price and production estimates hold. So if those forecasts hold up, we're looking at inflows that could be more than $4 billion a year into at least the next 7 to 10 years, and that's compared to a historical average of about $450 million a year. So when we say game-changing level of inflows, that's what we mean. We're looking at very significant differences there. And then, of course, to answer the treasurer's question, the caveat is always that energy markets are volatile. Shocks by their nature cannot be predicted. We don't know when they're going to happen, but we know that they can happen. And that is something that we plan for. So first thing that we do when we look at these estimates is we bake in conservatism into these projections. We look at various forecasts from Rystad Energy, Oxford Economics, the Energy Information Administration. We keep track with several different major forecasting institutions, and we look at what's going to be a reasonable price expectation that we can expect to maintain. And then we look at our production estimates, choosing reasonable growth rates based on those forecasts from various different agencies to say what is our most reasonable expectation for price and production, such that we can feel comfortable on investing according to that plan. And that's what you see here, those reasonable midline, middle-of-the-road expectations. And I showed you several different scenarios in our April meeting to show that we're sort of middle of the road in terms of those expectations. The second thing is that because we do these in-house, we've run stress tests on what it would look like if these inflows were to experience either a shock in 1 year, or if, say, the forward 7 to 10 year outlook, the energy transition outlook is more accelerated. What would that look like for our inflows? And we run that against our pacing model and our expectations for our asset allocation to say, would we still be in an okay spot to be able to adjust our pacing and still meet our liquidity needs if these inflows didn't come in the way that we expect? So that's how we're adjusting for that kind of volatility. The numbers that you see here are the numbers we're planning on. Those are our base case, but it's not the only thing that we look at, and we do make sure every month I run these again to make sure that we're still on track with our expectations, and we can adjust very quickly if it looks like these inflows aren't coming in the way that we have in our initial estimate. So this is not a once a year or once every several years thing. We're looking at this constantly. The next thing I want to turn your attention to, just so that you can know, this is a new sections of our annual investment plan. Starting on page 236, we have the portfolio analysis, which now includes both a discussion and at least the asset allocations for all of the funds under management. So we have information in here for you for each of the funds that we are managing. And then for the land grant, severance tax, and early childhood funds, we also include estimates for growth in the portfolio value and in the distributions from the funds. That, if you look at page 237, to give you an example here for the land grant fund, you can see the chart at the top of the page, those blue bars, is what the growth in the portfolio value would be using our base case estimate for our contributions, that page that I showed you on the inflows, and then our 50th percentile estimates from RVK's capital market assumptions to say this is a reasonable expectation for growth if those capital market assumptions are met and if those inflows are where we expect them to be. The other thing that we show you here on this chart, because inflows are such a big contributor to the growth that we're expecting over the next several years, we show you how that growth would differ if contributions into the fund were more than 50% of what we currently expect, because you can have spikes in prices or changes in the production outlook that can make that happen. And similarly, what would that growth profile look like if contributions were half of what we expect? Because if you go from $60 oil to $30 oil, you can lose half of your revenue at the same level of production. So you can easily go plus or minus 50% in these energy market inflows. And so we show you what those differences in fund growth would be under our base case and plus or minus 50% contributions. And we have that for each of the land grant, severance tax, and early childhood funds in this briefing for you. The next thing I'll turn your attention to also on this page is the land grant permanent fund distribution estimates. And if you look there in our base case contribution or base case contribution for the yellow bars, for fiscal year 23, we're currently distributing about $1 billion from the land grant fund. And by fiscal year 32, in any of these scenarios at a plus or minus 50% contributions, we could be looking at more than double, so over $2 billion in distributions to our beneficiaries. So just fantastic growth for the beneficiaries of these funds if these inflows come in anywhere near where we're expecting. The next thing I want to turn your attention to really quickly, page 241 of your diligent book. It's those same two charts for the severance tax permanent fund. But what I want you to see here is how Senate Bill 26, with the new billions of dollars in windfall oil and gas revenue. You know, we heard the legislature say they want to take excess windfall money from the industry today and invest it and save it so that we can grow those distributions in the future. And you can see that that's exactly what the current projection is for that to happen. So if you look at the portfolio value on the top, we're currently sitting on about a $7.5 billion fund. And we could be looking at anywhere between a $20 and $37 billion fund over the end of the next 10 years. Just astronomical growth, and that is because of that specific intention to deposit more oil and gas revenue into the severance tax fund over the next 7 to 10 years. And because we're getting more inflows into that fund, you can see the distribution estimates are growing rather significantly. Today, that fund distributes about $265 million and could distribute anywhere between $650 and $1 billion over the next 10 years under these different scenarios. So it looks like that fund could end up working exactly as the legislature intended when they passed Senate Bill 26 in order to grow those distributions. And then the last thing I'll point your attention to before turning it over to Mihail is for the early childhood fund on page 243.
Dawn, I'm sorry to interrupt you, but because it's on this particular topic, the severance tax permanent fund, you mentioned Senate Bill 26. Does this also include Senate Bill, I think it's 378?
Yes, it does.
Which also an additional $92 million in severance tax for 10 years?
Mm-hmm. Yes. And that's in addition to the prior legislation that sends another $24 million a year through 2028. Those are included. It also includes the $475 million one-time appropriation that will be in FY24 that the legislature also passed as part of House Bill 2 this year. So thank you, Wayne. I left those two out, but those are also included in here. So all of that, part of that account.
Thank you, Madam Chair.
And on page 243 for the Early Childhood Fund, we are sitting on today about a $3.5 billion fund. The contributions into this fund are based on fiscal year excesses of a 5-year average. The fiscal year is almost over, and we feel very confident that this fund will receive anywhere between $2.5 and $3 billion from excesses from fiscal year 23. Those likely won't be deposited until the end of the year. We're looking somewhere between September or December. But with those fiscal years almost over, those estimates are fairly solid. And so we're looking at an over $6 billion fund by the end of this calendar year. And then it could grow under these different baseline contribution scenarios anywhere between $10 and $15 billion over the next 10 years if our oil and gas inflow estimates hold up. The thing that I'll notice is that you'll notice very rapid growth in the near term, and then it sort of levels out after a few years. That's because the Early Childhood Fund receives excesses of a 5-year average. The longer we go, the more that 5-year average grows, the harder it is to beat that 5-year average. So those contributions get smaller and smaller. And we're expecting after 5 years that it would be unlikely to continue to receive inflows into that unless there were to be some other extenuating circumstances within the energy market. So we're looking at rapid growth in the near term, And then in the long term, this fund, rather than relying on contributions, will be relying on investment earnings in order to make distributions and to grow the fund. And that has been considered in the asset allocations that we presented to you last meeting, where we're looking at a different profile for this, rather than sustained large inflows for a long period of time for the other two funds. It looks like Early Childhood Fund will get very big, significant inflows in the short term, and then little to no inflows in the long term.
Madam Chair, just one comment on that. You would notice that the asset allocation that you all approved last month for early childhood looks a lot like severance tax. Tax's old asset allocation. It's for that reason. It's got the same structure as severance tax had prior to the changes made to the severance tax.
And if you look at the distribution estimates, I'll close with this on page 243. Right now, the Early Childhood Fund distributes $30 million as the baseline in statute. That'll increase to $150 million next year per an adjustment that was, or an amendment to statute that will increase that for 1 year. It makes the new minimum distribution $150 million. But you'll see that in the next couple of years, by FY26 or 27, if these inflows hold and revenues come in like we expect, those distributions could grow between $300 and $450 million just in the next couple of years, and then potentially anywhere between $500 to $700 million over the next 10 years. So pretty significant growth is expected for this fund if these inflows come in like we expect. And with that, I am happy to turn it over to Mihail to go over the risk portion.
Thank you, Dawn. Good morning, everyone. I will be referring to pages 268 to 272 in your diligence materials. So all the data in this report is as of end of Q1 2023, so March 31, 2023. And it was generated using the BlackRock Aladdin platform. This is the risk management platform that we have finally fully integrated, and at current juncture of time, it's fully operational. So that's where all the numbers are coming from. Before we move forward, let me just give you a brief overview. There are two main attributes to risk when you think about risk management. First is relativity, and the second one is the risk is a forward-looking measure. All of you know when we speak about the volatility, you always constantly think about the standard deviation of historical returns, and that's the angle that we look at. This report is a little bit different. So here, the volatility, when I speak about the volatility, I'm going to speak about the ex-ante portfolio return volatility. So it's pretty much the predicted return volatility based on BlackRock's parametric model at the 84% confidence interval. So just keep that in mind, forward-looking and relative. Page 269, there are three sections to that. So let's go over the first row. Just a very high-level data. The volatility of the portfolio as of March 31 is 15.35%. Volatility of the benchmark is a little bit lower at 12.36. The tracking error is 4.6%. We have set up the tracking error limit range between 3 to 5%. So this is what other peers of the same size and similar asset allocation are using. The target, the budget for the tracking error this is 4%. So you can see that we are within the range, slightly above the target, but we are keeping that under control. The next two charts is just asset allocation and then the asset allocation adjusted for volatility. So that's a pretty interesting chart. It pretty much says, shows the weighted standalone asset class volatility, and it answers the question, if the asset classes were not correlated with each other, what is the risk profile that we are looking at? So you can see that public equity is the largest chunk of that, private equity is the second, and real estate private credit are the third drivers of risk. But as we all know, correlations play an important role. So the second row is pretty much the visualization of the table that's at the very bottom of the page. And I would like to draw your attention to a couple of those bar charts. So the first one is the portfolio volatility contributions. So what are the asset classes that contribute the most to the total portfolio risk? And here, not surprisingly, we see public equities at a little bit over 50.5%. We see private equity, and the third one is the real return. Then Tracket's error contributions, pretty much the same profile with public equity and private equity being the top two. Private credit is the third here. So those are the main drivers of tracking error. And when I speak about the tracking error, I'm not speaking about tracking error in performance terms, which is the difference between the return of the portfolio and the return of the benchmark. We're talking about the difference in volatility of those deltas, of those differences. And the last chart on the right is the top and bottom three active positions. So this is from the Hirschman Index perspective. Pretty much the rule of the thumb in the industry here is you have an active position of over 2%. You have to look at it and probably diversify away from it. You can see here that our biggest active position is Microsoft at a little bit less than 0.5%. So this pretty much is the evidence that we are very well diversified on asset class, sub-asset class level. So that's what this chart means. I guess we can move forward to the next page, page 270. I don't want to spend too much time on it. So what you see here is the marginal contributions to risk and marginal contributions to tracking error. Just on a very high level, those marginal contributions are the marginal amounts of risk a particular asset class contributes to the overall portfolio risk per unit of weight. Not surprisingly, once again, given the information on the previous page, public equity, private equity are the highest contributors to total risk, and private credit and private equity are the higher contributors to tracking error. So that's what this table means. I would like to draw your attention to the next page. It's page 271. So here we see the historical analysis scenarios. We decided to pick 10 different scenarios for you, and we stressed our portfolio in a variety of different ways. So we have a couple of macroeconomic scenarios. We have one geopolitical scenario. We have even included the healthcare shock to the system, which is the pandemic recession. So the way you read it, and again, this comes from the industry and academia standards. If there is something something higher than 20% drawback, it means that you are not well diversified, and you have to take actions and you have to take steps towards that. As you can see from this table, the highest drawdown for us would be if events of stagflation of 1974 happen to repeat themselves in the future. In that case, in the worst 5% of the cases, we will lose 15.6%. Again, this is much less than 20%, and what it says is that we are very well protected from the downside. The way that we are constructed, the downside protection component is in there, and it's working fine. So we're going to be looking at those scenarios and changing them from time to time, but what we're looking at is a 20%, something over the 20% drawback, which is not the case at this point of time. And the last page, it's page 272. So the way you read this chart, so you have the asset class analysis at the top and the sub-asset class analysis on the bottom. And then if you look at those triangles, the lower left corner triangle is the correlation matrix for the past 32 years. And the upper triangle, upper right corner triangle, this is the change in correlation for the past 12 years. So since 2010, since after the global financial crisis. And the reason we look at it and the reason we even talk about it is the fact that you might have heard over the last year or 2 years on TV, in the newspapers, everybody is talking about the breakage in correlations between asset and sub-asset classes. People are saying that, well, these asset classes are not that correlated, so we have to play the field differently. What this analysis shows that not only there is no breakage, but also you can see most of the asset classes and sub-asset classes have the stronger correlation between them. So how do we counter that? Through diversification. Over the last couple of months, you've seen a couple of asset allocation discussions. We've changed our asset allocation. We changed the structure of some of the asset classes. And all that is pretty much targeting this problem. The correlation between asset classes, we try to diversify as much as we can on both asset and sub-asset class levels so that we are well protected on the downside going forward. That's what this matrix shows. I think that would be all, and if there are no questions, I'll pass it on to Nino to talk about basin analysis.
We're going to take questions after all three.
Sure.
Good morning. I'll start just with a little backdrop here. So several years ago, to better achieve the target allocation for the private asset classes, staff developed a proprietary pacing model. Our model is based on the Yale model, which has been widely accepted across the institutional investment community. We spent a considerable amount of time applying that methodology to an Excel-based model. And then in the years that followed, we built upon that methodology to meet the needs of the private asset classes. And just also to point out that the model's been reviewed thoroughly, both internally and by our consultants. The pacing model, it provides a projection of the minimum annual commitment adjusted for participant growth rate that's needed to achieve and maintain the target allocation over a given period. The conditions described throughout the annual investment plan, along with a desire to achieve target allocations in an accelerated time frame, have resulted in substantially higher levels of commitment. The tables that you see here, I'm on, page 248. The tables contain the commitments and the resulting net asset values and allocations for the private asset classes. The target allocations would be achieved in 5 years and then maintained through the end of the 10-year look forward, which is the green shaded area. One thing I'd like to point out is if you take a look at commitments, you can see that our forward-looking commitments in aggregate, we're probably looking at over $6 billion in commitments in order for us to achieve these target allocations. And then to maintain them, we're probably looking at something, in the order of anywhere between 4 and 6 billion. If you take a look at the resulting NAV, you can see that, at that time so 5-6 years, 2028, 2029, the NAV of the private asset classes is projected to be larger than our current total fund NAV. And at the end of the 10-year look forward, we're looking at the private asset classes comprising $52 billion of the total plan. Next, the next 3 pages, I'd like to walk you through some charts that show the commitments, net cash flows, cumulative net cash flows, net asset values, and the allocations since inception for the private asset classes. I believe they tell you a story. And let me just go over quickly how they're organized. So each private asset class has a chart, and then they're basically grouped by a common variable. And so the first series of charts we have are commitments, and the gray shaded bars, those are prior year commitments, and the turquoises are forward-looking plan. One thing you may notice right off the bat is prior year commitments appear haphazard, but that's not the case. Those prior year commitments are shown by vintage year, and forward-looking commitments are shown by commitment year. We have control over commitment year. We do not have control over vintage year, which is the year in which a fund begins making investments. And so that's why those can appear a little bit lumpy. The other thing you may notice is the 2023, so the current year commitment number is higher, is quite higher than the remaining years, and really that's just a function of prior year commitments that haven't begun investing yet, and so those are going to roll forward into 2023. So what you can see here is that, the contributions from the higher levels of commitment, they result in net cash flows either turning back or remaining negative for longer and deepening, which helps us to absorb the excess liquidity. And those would be the bottom charts. So if you take a look at, our net cash flows, you can see that with a couple of the private asset classes, private equity, and real estate and real return, recently the last few years, they had turned net cash flow positive and would continue on that trend had we not adopted our current plans. Those are a little more mature and typically tend to have shorter fund lives and shorter duration type of investments. You may notice significantly negative net cash flows for private debt here the next few years, and that's a result of the addition of several open-ended funds of one. Typically, the capital is drawn down very quickly, typically within the first year, and so that's what's causing that bit of an anomaly. So then if we turn to page 250, we can take a look here at the cumulative net cash flows. And so this is essentially an illustration of the J-curve. So the negative net cash flows, they lead to a double dip in the J-curve, which you can see here in the chart. And but as Vince pointed out earlier, by remaining invested, capital can continue to compound further. And then the remaining charts, we go over net asset values, and then on page 251, we have the allocations, and then we also have the target allocation there in red. And so, as you can see, we're projected to achieve the target allocation in 5 years and then maintain it through the 10-year look forward. When we do achieve the target allocations, then at that time, we have a decision to make whether to increase them further or keep them where they are. The current plan has them staying where they are, but if the decision is made to increase them, then we would just adjust our plan accordingly.
How do you know where the target allocation is on the chart?
I'm sorry?
How do you know where the target allocation is on the chart? Is it marked?
Yes.
The red dotted line?
The red dotted line?
On 251.
Got it.
Okay. So with this increase in internal capabilities, pacing is no longer a once-a-year exercise, but it's a continuous process where staff and our consultants work together to update the model with current information and adjust our plans accordingly. The pacing model as well, it also provides us a method to perform scenario analysis, where we can evaluate the changing impact of inflow estimates, commitment levels, assumptions regarding contribution rates, distribution rates, performance, and just lastly, the model ensures that we have a consistent methodology that's being applied across the private asset class.
Madam Chair, just a couple comments if I could. The most important charts on all those charts are important, but the most important charts there are the four at the bottom on page 249. The blue bars there that you see are cash drawdown. That's your compounding machine we've got in place now. That's providing the opportunity to put profits from our stock portfolio and our bond portfolio, and to a degree our private debt portfolio, back into the market into diversified risk assets. So that's the compounding machine here. Then you see in the out years how those bars starting to go up. If Nino had stretched that chart out for more years, those bars keep going up. You're building a cash machine here. This is a cash machine. It will generate hundreds of millions of dollars into the future. So we've got our compounding up front while we've got really good inflows into the funds. As those start to wind down, these investments will be maturing and providing big cash flows back to the market. It's quite second comment I want to make is we have worked really hard to build that team right there, and we're very proud of it.
And as Vince noted, as if we did carry this out a little further, we would have to go from landscape to portrait.
Questions from council? So y'all, we have to take a vote to approve this investment plan.
Madam Chair, based on the recommendation of the Council Investment Committee, consultant RVK and SIC staff, I move State Investment Council endorse the 2024 annual investment plan as memorialized in today's meeting materials and as reviewed and discussed by the council today.
All right, we have a proper motion by Member Lavender, a second by Secretary Pop. Any discussion on the motion before the council? Hearing none, we'll take a roll call vote.
Madam Chair?
Yes.
Treasurer Montoya?
Yes.
Secretary Pop?
Yes.
Mr. Tejas?
Yes.
Catherine Allen?
Yes.
Mr. Bingaman?
Yes.
Mr. Jennings?
He's not for this.
Mr. Lavender?
Yes.
Mr. Messina?
Yes.
Mr. Sommer?
Yes.
Madam Chair, you have 9 in favor.
So, with that out of the way, we have a request to move agenda item 3C, which is our interim asset allocation recommendation vote, to the August meeting. I'm not sure if we need, all right, so let's move on to agenda item 3E. Sorry, 3B has been moved down to the bottom of the agenda. 3E, a vote on our private equity, Sweetwater Private Equity 3, and we'll turn it over to Mr. Cassidy.
And Madam Chair, if I could remind people to make sure mention the page numbers, because when they're going forward and then backwards, it's really hard for us to follow online.
Yes, a good reminder. Thank you, Madam Treasurer.
Ready? Okay.
Page number, sir.
We're on page 293. We're recommending a commitment of up to $50 million to Sweetwater Private Equity Fund 3. We're joined by Richard Pugmire from Mercer, who's our advisor of the program, and James Gammett from Sweetwater. Sweetwater is a secondary firm that looks to purchase stakes in individual companies. You know, what the average secondary fund does, they purchase stakes in LP interests. For example, all the funds we're bringing today could, in theory, sell those stakes in the secondary market if we chose to, and there's a whole buyer universe for that. What Sweetwater does is they buy actual equity positions in individual companies from sellers. And the reason this strategy kind of resonated with us is they look to find sellers in privately negotiated transactions that have some type of pressure, whether it's time or liquidity reasons, they need to sell. And I think we're getting into a phase of private markets over the next 5 years where you're probably going to be able to earn a premium by being able to, a liquidity premium by being able to step in and buy at a discount from a seller that needs out. The other thing we like about the strategy is Sweetwater picks the companies it wants to invest in and is able to do due diligence on those companies versus when you're buying a huge portfolio of limited partnership interests, kind of a big beta bet. You're just buying a bunch of positions, you know, hopefully at a discount, hopefully the good companies offset the bad companies. In this case, they're able to actually do bottoms-up research and find companies that they actually want to buy. Which is, the asset level due diligence is really impossible to do when you're buying LP stakes. And then finally, the other thing that we really like about the strategy is it avoids a double layer of fees. The average secondary fund charges fees both at their fund level, and then obviously the positions that they're buying have underlying fees as well. And that translates into some pretty significant fee savings over time. So I'll hand it off just quickly to James Gamet to make some brief comments, and then we'll open it up to Q&A.
Great, that was a great overview. You kind of took most of the words out of my mouth. The only thing I can really add is we built a real senior team. So the senior investment professionals have over 100 years of secondary experience. My background real quick, I came from, I was head partner of secondaries at Stepstone for 5 years prior to forming Sweetwater, and before that as a portfolio advisors, one of their first hires focused on secondaries. So I've been at firms doing some of those LP interests and seeing how that got commoditized, shifting our focus more to what we call buyer-led secondaries, where we, the buyer, are driving the asset search and then finding these stressed sellers. And I think this environment where 70% of the liquidity in private equity is dried up and sellers don't know where to go to get liquidity. And as that pressure builds and builds, we get bigger and bigger discounts. And so we enjoy seeing some pain and some pressure in the marketplace because that means that there's good buying opportunity.
Questions from council on this investment?
Madam Chair, this was, investment was unanimously recommended by the investment committee to the council. Based on the recommendations of the Council Investment Committee, Consultant Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $50 million to Sweetwater Private Equity 3 LP, subject and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second, Nick.
Okay, we've got a proper motion by Member Lavender. We had a second here by Member Messina.
Okay.
And a third by Member. Any discussion on the motion before the council? Please take a roll call vote.
All right, Madam Chair. Treasurer Montoya,
Yes.
Secretary Prost,
Yes.
Mr. Tejas,
Yes.
Ms. Ellen,
Yes.
Mr. Bingaman,
Yes.
Mr. Lavender,
Yes.
Mr. Messina,
Yes.
Mr. Sommer.
Yes.
9 in favor, 9.
Thank you for doing that.
Thank you, appreciate your time.
We're going to go to agenda item 3F, which is a fixed income investment into Atalaya Income Evergreen. Turn it over to Mr. Lofton and Nikita.
Thank you. And ask representatives from Atalaya, Mr. Zen and Mrs. Chia, to sit next to me. So, Madam Chair, members of the council, thank you. As you mentioned, this is item 3F. We're on page 343 of your materials. I'm also going to have Mary Bates, who's joining us online from Makita, supporting me in today's presentation as well. First off, I'd like to thank Mr. Zen, Ms. Chia, for making the travel out here. Maybe for Mr. Zen, since your mom and your family are here, not as big of a step, but thank you for being here. So the recommendation for 3F today is a commitment for $300 million to Atalaya Income Fund Evergreen. This recommendation is by staff, myself, and with support of Nikita. AIF, or Atalaya Income Fund Evergreen, is managed by Atalaya Capital Management. The AIF Evergreen strategy is a specialty finance oriented strategy with a focus on generating current income. The strategy really can be broadly summarized as lending to lenders. wherein AIF Evergreen, the loans are collateralized with underlying assets of the originating lenders. As far as the target performance, the gross target performance is 13 to 16%, net is 9 to 12. The focus is on generating current income. As far as the fit within the portfolio, it's going to go within the asset-based strategies category. Reason staff views this commitment positively. First off, the market opportunity. I post-GFC, but actually pre and post-GFC, I had the opportunity to trade and invest a fair amount in public markets. Quite a bit of that was investing in and trading asset-based securities in the public side. So I got to see firsthand the resilience of this product. I also got to see firsthand the broad diversity that you can achieve in this product. Many of these loan pools, they're comprised of hundreds, if not thousands, of underlying loans, consisting of borrowers from a broad range of geographic, socioeconomic backgrounds. So it really kind of boils down to a statistical process. Adelai's experience over 15 years investing in this product, and I think Mr. Zinn, you've been doing this for what, 26 or so? So quite a bit. You've been through quite a few market ups and downs. Adelai's market presence. So approximately 75% of their funds are invested in deals that are sourced through repeat relationships. So their clients have strong relationships with them. From a vehicle standpoint, the reinvestment option to reinforce the strategy group's themes today, within private market debt strategies, our overriding goals at this point, given the SIC's positive cash flows, reinvesting, certainly greater collateral diversification. We're going to drive improved economics through our commitment size. We're a big fund. We can throw our weight around a little bit. Custom and evergreen solutions as well. And then we're focusing on yield as the primary driver of return, with opportunistically catching upside with price, but really focused on yield. So I hit on the diversification. Just quickly on the structure with this evergreen. So AIF Evergreen invests in with what I would term as a series of pools of assets. Investors have the option to invest for a 3-year or a 5-year lockup of committed capital, and then at the end of each pool's investment periods, each limited partner can take advantage of recycling, principal, and yield, and essentially extend those 3 or 5-year commitment periods indefinitely. So there's a lot of advantages not only to this investment strategy, but a lot of advantages to this vehicle as well. I would say the key risks and weaknesses for the strategy. Number one, there's been an exceptional growth in the market, and a lot of new investors in the market, a lot of new GPs that are kind of following Adelai's footsteps. The market has grown quite a bit as well. The opportunity set has grown. So with that comes a lot of complexity, comes a lot of competition. So it's good to have a manager that has experience, that has strong relationships. And this, I mentioned the operational complexity. And then I would say that Adelai's strategy is primarily focused on consumer-oriented type lending. The consumer is pro-cyclical, so there is some risk there. From my standpoint, I think that is offset, like I said, by the exceptional diversity that you can find in the underlying borrower group. So with that, I'm going to ask, I usually leave out something important. So Mary, did I leave out anything important?
No, I think that was great.
And so, Mr. Zinn, do you have any comments you want to give?
Sure. First of all, I'm quite honored to be here today in my home city, in my home state. My family, born and raised across the state, Clovis, Tucumcari, Gallup, of course, Santa Fe. So, proud to be here today. My family's beneficiary, or I should say indirectly beneficiary of a lot of the work that the SIC has done. So makes me really proud. Now, I'm actually much more local product. I like to think that I'd be a founding investor, or at least a steward of the SIC's capital that's born closest to the capital. I was born and raised in a house that my mom still lives in, about 4 blocks away on Dongus Bar. So, and she still lives there. As you're going past Wood Gormley up the hill, that's where I grew up. And I think I'm also a product of the Santa Fe Public School system. If I had my Santa Fe High letter jacket, I could show you my credentials, but we don't know where that is anymore. And really, ultimately, I give that preamble as a thank you to you and to your predecessors for forming and for endowing these permanent funds to be the beneficiaries that I just mentioned. Now, many friends and family have worked in this building and passed through these halls, but when the 3rd generation New Mexican, it's hard to compare with the governor's 12th generation legacy. So I'm not here to talk about that as much as I am to talk about Atalaya. And now you all may be one of the few people who actually have heard the word Atalaya before. And as you may know, it's Spanish for watchtower. I wanted a name that was both evocative of New Mexico and something that was deeply important to me, as well as Spanish for watchtower being a giving perspective and protection to the capital which we're accustomed to. So that's ultimately why I chose the name. Now, Via was a second runner-up, if you will, or close runner-up, but as a person with the Z name who lived at the end of the alphabet, this was my chance to jump to the front of the line with the A name of Atalaya. So, but in terms of the Atalaya business, I started the Atalaya business 17 years ago. As Tom mentioned, we've been doing this for a while. Today, we have about 120 team members. Most of those team members are in New York. We have a smaller office in Dallas. Sorry, we haven't gotten to the size yet where we can have a Santa Fe office, but we're working towards it. In this particular strategy that Tom mentioned, we've been running this strategy for more than 12 years. We made several hundred investments, invested more than $5 billion in this asset-based and specialty finance strategy, and in that $5.5 billion, we have about 20 basis points of loss. So I think this, as Tom mentioned, is a great diversifier to what typically is corporate credit. It provides both diversification and resilience that Tom mentioned. It can allow, hopefully, the permanent funds to compound, as I heard before. You all are in the luxury position of being able to invest from a position of strength. Many of these meetings we have, people are trying to catch up. You all are certainly in an amazing position, so it makes me proud to hear that. And certainly, I want to do that and just open up the questions. I've covered much of the strategy.
Chair. Mr. Zen, this is a personal note. Were you related to Judge Zen?
To Judge Zen? Indeed, my great-grandfather.
Well, I appeared in front of him. He was a very impressive guy.
That's amazing to hear.
That was a long time ago.
That makes me glad to hear. My dad's sitting right behind you. I'm sure that makes I'm glad to hear. I think we should all be glad he didn't bring a sign. And,
I might add, I really hope you can get an office here as soon as possible.
Well, we've got to grow a little bit more, but certainly you're not the only one.
Madam Chair, question. Yes, just a question about reputational risk. What are the loan practices, interest rates, debt collection practices of the partners that you're investing in? And is there anything there that might blow back to impact us from a reputation point of view?
Sure. Well, that's certainly a relevant question, and something that we absolutely ask ourselves and get asked about. Many of our clients look very similar to you all in terms of large public plans or plans in sovereign wealth cases as well, that same exact focus. So we are certainly focused on that. Recall, we're a lender against and secured lender against pools of assets. We're not originating the loans ourselves. We're lending to lenders, as Tom mentioned. Now, that doesn't mean we don't care what goes on. In fact, we're very focused on what the originating companies are doing and what those practices are. really our focus there is based upon this idea that we're focused on the providing of utility to a customer and a consumer. So for example, really what we're trying to do there is make sure that the customer gets utility from whatever that loan product may be. What that means is that we're very focused on making sure any products don't create a debt trap for consumers, that we do not do things like payday, title, on, and other high-interest loan products that we think at least can result in a debt trap. So we're really focused on utility for the consumer, and that's something that's at the forefront of our mind when we're making these investments, because we're ultimately stewards for capital for folks to look exactly like you all do.
Madam Chair.
Madam Treasurer.
Thank you, and thank you for your presentation. To Member Ellen's point, and for the record, on page 264, I was listening to the presentation, looked at the docs and saw, wow, this is a really good rate of return. This is a perfect time for it. But of course, the predatory lending aspect did concern me. For those that are concerned about that, Atalaya also ensures that it is not participating in any form of predatory lending, which is outlined explicitly in the firm's ESG policy and approach. And I personally really appreciated that. Specifically, you're from New Mexico. New Mexico just passed a law this year to remove predatory lending and go down to 36 or 37%. So I really appreciate that you put that in your model to make sure that we're taking care of New Mexicans and others. So thank you very much. Appreciate it.
Thank you. Yeah, we are focused on ultimately products and strategies that are good for the consumer. In fact, we think any products that are in the predatory category that are bad for consumers or bad businesses and something that we don't need to stand. That's our philosophy.
Further questions? Madam Treasurer, would you like to make a motion?
Yes, Madam Chair, I'd be happy to. Based on the recommendation of the Council Investment Committee, Consultant Makita, SIC staff, and General Fiduciary Oversight of RBK. Am I right? RBK, yes. I move that the State Investment Council approve a commitment of up to $300 million to Atalaya Income Fund Evergreen, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation and final terms and conditions, and completion of appropriate paperwork.
Second.
We have a proper motion by the Treasurer, a second by Member Lavender. Any discussion on the motion before the Council? None. We'll take a roll call vote on the motion.
All right, Madam Chair.
Yes.
Treasurer Montoya.
Yes.
Secretary Cox.
Yes.
Mr. Tejas.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Mr. Lavender.
Yes.
Mr. Messina.
Yes.
Mr. Sommer.
Yes.
9 in favor.
Okay, very good. Thank you all. I think you all can be.
Yeah.
Okay, Mr. Lawson, stay right where you are. We're going to agenda item 3G. Another fixed income recommendation to HPS SLF strategy.
I'm going to invite members of the HPS. Jennifer will be here. Are we ready? Okay. All right, Madam Chair, thank you again. Members of the council, thank you again. This is item 3G. We're on page 430 of your materials. And once again, I'm supported in this commitment recommendation by Mary Bates from Makita. And I'm also supported with members of the HPS team Mr. Adam Jordan and Ms. Jennifer Bates. Thank you both for making that.
And Michael,
I pointed at you only, but.
he's on Zoom.
Oh, yes, yes, okay. Michael? There, Mr. Patterson.
Thank you.
Well. So to get started, SIC staff, in consultation with Nikita, recommends a commitment of $300 million to HPS Specialty Loan Fund Strategy.
Did you say page 430 already?
430, I did. That's okay. HPS was founded in 2007. They're a large firm, one of the larger ones out there. They manage over $100 billion, with almost $50 billion in specialty direct lending and senior lending strategies. They have, I think, 15 or so offices globally, almost 600 employees. SIC has been investing with HPS since 2013. On the first page of your staff memo, you'll see the prior investments that SIC has been involved with HPS. Throughout that investment history, it's been with this specialty loan strategy. So SIC has a lot of experience working with HPS on this type of strategy, and certainly helped us get that experience, helped us to the performance, the experience, the communication with HPS helped us to become comfortable with making this recommendation today. The specialty loan fund strategy focuses on what's called non-sponsored first lien financing to middle and large middle and upper middle market companies. The SLF series was launched by HPS back in 2010. Non-sponsored, so a sponsored is essentially if a private equity firm, they want to do an LBO or some sort of transaction, and they need financing for that transaction, that's essentially a sponsored lending relationship. Non-sponsored is really going direct to the corporations and lending to those specific corporations for whatever needs they need, whether they're starting up a new vision, a new business line, or doing their own M&A. You target returns for this strategy, 17 to 19% gross, 10 to 14% net. On that total targeted return, I think the targeted yield is something around 10%, with about 1 to 4% on top of that for pricing and fee returns. And within the private market strategies allocation within fixed income, the strategy would be assigned to the direct lending strategies category. As far as the structure, it's a new structure for our relationship. It's a new vehicle. I'll call it a new vehicle for our relationship with HPS. I mentioned earlier that private markets is focusing on more evergreen, customized type vehicles. This is going to be through a fund of one, essentially the same thing as a separately managed account. We'll just be, SIC is the only investor in the fund, so it's called a fund of one. SIC funds will remain committed until and when SIC terminates the fund of one, and SIC may increase or decrease committed capital periodically. Since funds of ones are not commingled vehicles, they can be customized for SIC's needs, and SIC can change the strategy exposure periodically. Those are some of the flexibility items that you don't get with your normal term commingled type product. And importantly, from my standpoint, these funds of ones, they'll reduce the SIC's administrative burden and cost as things like setup, underwriting, legal, due diligence, accounting. It's really done once, and then it's amortized over a much longer fund life. So a lot of efficiencies, economic efficiencies there. As far as the key risks and weaknesses, sourcing. If you're going out to specific companies, you're sourcing. You have to maintain a number of relationships with those corporations, and you also have to have industry expertise. So there's some complexity there. Underwriting, you've got to maintain that industry expertise. And then I would say another, what Nikita and I saw as a weakness, you could say alignment. The HPS sticker price, call it, is that you guys start out high. The nice thing about it is that they scale down rather steeply with commitment size. And our underlying fee, which is not public, happy to share that later on, but our underlying fee structure was scaled down significantly, and more so for this fund of one. As far as the reasons we view this favorably, certainly downside protection. This strategy is geared towards larger borrowers. They tend to have lower default rates, higher recovery experiences. The target for the strategy is 90+% senior secured liens. And importantly, from my standpoint, HPS also maintains an internal workout team. They don't have to go external if something becomes troubling. As I mentioned with Atalaya, this fund of one allows for a reinvestment option. We'll be able to reinvest both income and principal. HPS's experience, they've been doing this type strategy since 2012. Certainly, I mentioned their scale, given their size earlier, which was also made us very comfortable. Mary, did I leave anything out?
No, the only thing I might just clarify is one of the reasons that we're electing to do a fund of one is the flexibility to reinvest the income that isn't an option in the commingled fund.
Correct. Thank you. And so with that, I'll turn it over to Mr. Jordan.
Yeah, thank you, Tom. That was a great introduction to the firm. And I'm Adam Jordan. I'm your primary staff contact. I'm joined by Jennifer Bale. Jennifer is the strategy head for our specialty direct lending business. She's been with us for over a decade. And then Mike Patterson is in New York. Mike co-founded HPS in 2007 and has been portfolio manager for the strategy since inception. So we're appreciative of the partnership that's on its second decade. We're happy to be here to talk about the evolution of this relationship into this type of structure. This is where a lot of our large relationships end up, so we're very comfortable with these types of structures. I'm going to save my remarks and turn it over to Mike and let him give you a little more color on our philosophy and the platform, and most importantly, tackle any questions that you may have.
Great. Thank you, Adam, and thanks for the opportunity to speak today. As Adam said, I'm Mike Patterson. I'm the global portfolio manager for direct lending, one of the co-founders of the firm and one of the 5 governing partners. As Adam mentioned, we have had a long-standing relationship with New Mexico and a successful one. And so we look forward to your consideration for taking this to the next level, which is to convert it into an evergreen structure. As Tom was saying, this is different than the way we've invested together or partnered together over the past decade, but it is a very familiar structure for us. More than half of our capital in direct lending is done through these single investor funds. So we are very familiar with them. We run a number of them. I think in terms of the specialty lending strategy, and I know that you're a well-versed and experienced investor in private credit and in direct lending, there are a couple points of differentiation. I think Tom highlighted the most important one. We cast a really wide net. Happy to talk to private equity firms about potential leverage buyouts. We find that's the most commoditized and most trafficked space in private credit. So when we cast that wide net quickly, we usually narrow it down to things where our capital is valued a little bit more and the approach is a little bit more differentiated, and that's the non-sponsor world. So these are big. Non-sponsored doesn't mean small. These are significant companies. The average EBITDA is $100 million, and so that means several $100 million of total revenue. We think the significance of the underlying franchises is an important part of the risk mitigation matrix. But another important part of risk mitigation is control. We control 82% of the loans we make, meaning we are the majority lender. This isn't a strategy where we're clubbing up with a bunch of other lenders to come up with a solution. We're driving the diligence, we're driving the documents, and if something goes wrong, we're using that restructuring and workouts team that Tom mentioned. 9 senior people on that team, and significant additional legal and restructuring resources that we bring to the bear when something goes wrong. We're using that to try to drive better outcomes. Our over the 13 years of this strategy at HPS, we've made more than 310 investments, invested more than $50 billion of capital, and our cumulative loss rate is 1 basis point. That's been in a benign credit environment the last 13 years. I think we acknowledge that, and I think anybody that doesn't isn't paying attention. But that is still significantly less than averages in non-investment grade lending, and we're earning a really significant premium on top of that. 428 basis points average premium compared to the broadly syndicated loan market in the loans that we originate and invest in. I'll pause there. I mean, but one comment on the opportunity set. We look at the opportunity set today and think it is pretty extraordinary. Usually in a period of rising interest rates, we see spreads in our business, the credit spread, which credit spread plus base rate equals the total coupons we earn. They usually move in opposite directions. In today's market, where we're seeing just a scarcity of capital on the credit side, they moved in the same direction. Base rates went up and credit spreads went up. So we hope to capture that for our investors over the course of the next 3 years.
Also question.
Madam Chair,
Madam Treasurer.
I'm glad that Mr. Lofton did mention the fees aspect of it, because that was one of the concerns. My question is based on page 458, third paragraph. Let me see how I word this. Can you tell me if the high risk areas of concern in the packet are also some of the investments that we're looking at with this deal?
We could go to Ms. Bates for that answer.
I'm sorry?
I'm going to have Makita answer that one.
Thank you.
I'm sorry, I'm gonna have to pull that one up. I don't believe, I believe that's very broadly written language, so I don't think there's anything of concern, but we'll have to refer specifically.
Madam Chair, and Ms. Mary, it's actually very detailed high risk concerns. Not limited to, but including. And I wanted to know if all of those were included in the investment position that we're looking at before us, or if that's just part of some of the other aspects of the strategy that they have with other investments, or if that's something that SIC would be also investing in as part of this strategy.
Yeah, apologies. I'm having a hard time referencing the document right now. So, I mean, as
You're on page 27 of your presentation.
Thank you. I mean, overall, we have no overriding concerns as it relates to this this investment. I mean, there are broad risks associated with any investment. The key risk associated with this is default risk. As you know, as Mr. Patterson outlined, this manager has less than 1 basis point of cumulative defaults. So, I mean, we don't have significant risks. We don't have significant concerns with this investment. We'll always highlight and articulate there are investment risks similar to as you would see in any language in a PPM.
And we're going to have Mr. Hand also.
Just to briefly translate what I think I'm hearing for Ms. Bates' benefit, because sometimes it's hard to pick up on the Zoom. The memo, as I understand it, and what you've referenced, relates to general investment risks from this particular strategy. Those risks will exist our fund of one evergreen because it largely replicates a commingled fund, albeit with reasons we do it for purposes of negotiation and fees and so forth. And you're hiring, if you choose to vote on this manager, their ability to invest appropriately and fiduciarily around those risks based on things like loss ratios and other things that have been addressed in the presentation. So to answer your question, yes, those risks exist, particularly in this field, and the reason Tom presumably brought this manager is for their ability and track record in addressing those risks.
And I would just quickly add this, I know what items you're referring to, Treasurer Montoya. This list, these were predefined by HBS as risks that they specifically, through their ESG policy, investments of these types, that they would specifically avoid as part of the strategy. So, yeah, this is actually an added, these risks that you highlight, that's a predefined list by HBS, so that added frankly a degree of comfort, because as we spoke in the last commitment recommendation, as well as this one, we are a public institution, and headline risk, whether it's morally right or morally wrong, headline risk is something we want to avoid, and investments like these are ones that we have to be cognizant of. So.
Madam Chair, Mr. Lockton, thank you so much. So that means that we are not investing in those specific items, correct?
Correct.
You are a rock star. Thank you. Thank you, Madam Chair.
Yeah, Madam Chair.
Member Messina.
Thank you. I just want to compliment you on that ESG consciousness and emphasize how important it is to recognize that with that consciousness, you can still have wonderful returns. So thank you very much.
Further questions? Do I have a motion?
Based on the recommendations of the Council Investment Committee, Consultant Makita, SIC staff, and General Fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $300 million to HBS Specialty Loan Fund Strategy, subject to and contingent upon Mexico legal requirements and Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
And now I'm happy to second it.
All right. We've got a proper motion by Member Lavender, second by the Treasurer. Any discussion on the motion before us?
Madam Chair.
Oh, I'm sorry. Member Jennings.
Yeah, Madam Chair, I tried to vote on the last two items and I could not ever get in. I don't know what happened. I hung up and called back. But I don't have a problem with this, but I definitely tried to vote on the last two items, and for some reason, the unmute button or whatever, I was muted all the time, no matter what I did. So just, if you put that on the record, I don't know if that's ever happened to anybody else, but it happened to me. I could hear everything everybody said, but when it came time to voting, I don't think I was shown as voting.
All right, we appreciate that, Member Jennings, and we'll let the record reflect.
Thank you.
But we can see you loud and clear now, so maybe you should start with him.
All right, Mr. Jennings, how do you vote?
Yes. Yes.
Madam Chair?
Yes.
Treasurer Montoya?
Yes.
Secretary Cross?
Yes.
Mr. Tejas?
Yes.
Ms. Catherine Allen?
Yes.
Mr. Bingaman?
I need to recuse myself on this vote. I can explain if anyone's interested.
Mr. Lavender?
Yes.
Mr. Messina?
Yes.
Mr. Singh?
Yes.
We have none.
For that, and thank you all for being here with us. Thank you. Next, we're going to move to agenda item 3H, LS Power Equity Partners 5, and we'll turn it over to Mr. Sable and Mercer. table page number 6.
Madam Chair, this recommendation will be for a commitment of up to $150 million for LS Power Partners 5. The staff memo begins on page 555 of your board books, the consultant materials on 557, and the GP's presentation on 578. Wanted to lead off by thanking Amy Ridge and her Mercer colleagues for their help in underwriting and bringing this new relationship to SIC. I think when you had a chance to review it, you'll be as excited as I am about their participation in our portfolio. This investment would be allocated to the energy sleeve of the real assets portfolio. LS Power Equity is seeking to raise $2.5 billion for Fund 5. It's a modest increase over the prior vintage. In terms of history, LS Power Group was established in 1990 and has since deployed $49 billion in equity and debt capital. Up until 2005, the company operated as a power and energy development enterprise focused on transmission and generation. The company sold its generating assets in the 2000s before establishing LS Power Equity in 2005. A new entity was established to facilitate the company's access to capital through the private equity markets. Since 2005, LS Power Equity has raised over $10 billion in 4 funds and other investment partnerships. Each of the prior vintages are top quartile performers in the relevant Burgess universe as measured by TVPI, IRR, or both. What we like, the relationship with LS Power Group is a key part of LS Power Equity's edge. Through LS Power Group, the GP can access 320 employees focused on development, operations, finance, investments, public relations, and compliance. Access to these resources enables the GP to quickly and efficiently target assets that are burdened by complexity where other funds would face delays and costs associated with the use of external advisors. Sectors, actually I should go back to investments. The GP takes controlling stakes in targeted businesses, enabling value creation through the implementation of its business plans. Broadly speaking, these plans rely on LS Power's deep operating experience in the space to drive revenue enhancement, asset optimization, policy advocacy, and strategic financings. Sectors of focus include distributed energy resources, renewable energy, and conventional energy generation, with a focus on low-cost peaking capacity that's supportive of green energy alternatives. In terms of alignment, I would suggest that the GP is one of the most aligned I've seen in my time in the business. Carry-eligible staff include the fund's investment committee, heads of platform services, and deal team members down to the vice president level. The GP commitment will be also one of the largest compared to market norms. Importantly, investors who wish to receive, or employees rather, individuals wishing to receive carry must invest cash into the portfolio, and therefore they share any downside risk that we would bear as an LP. With those comments, I think I'll just pause and ask Richard Pugmire if he had any other details he'd like to add, and if not, we'll hand off to Darpan and Emily.
Yeah, and the only thing I'll mention is we've known LS Power for years. As other clients invest in it, we're excited to introduce it to you.
Great. Well, thank you for that, and thank you all for the opportunity to present here today. My name is Darpan Kapadia. I'm the Chief Operating Officer of LS Power. I've been with the firm since 2004. I'm a member of the Management Committee and Investment Committee. With me is my partner, Emily Simonis, who's the Head of Investor Relations with the firm since 2011, and also I'm a member of the Investment Committee. Thank you again for those introductory remarks. I think you summarized our strategy and our firm quite well. I'll try and add a little additional color to it. As Keith mentioned, we really think about ourselves as more of a strategic investor in the space. We've been doing this since 1990, initially as a development company in the business of developing, building, owning, and operating utility-scale generation throughout the United States. In 2005, we evolved into an investment manager to get into the acquisition business. And since 2005, we're raising our 5th flagship fund, over $10 billion in capital that we've deployed into the space. I think key to what we do is the platform that we've built over 30 years. As mentioned, we have over 300 individuals, employees at the LS Power level, not at the portfolio companies. Those are additional employees as well as projects. So we've really invested in the resources of the firm. to make sure we can identify the best opportunities and add value to those situations as a value-added energy infrastructure investor. When you look at our organization, we're a bit of a hybrid. Around half of the firm looks like an investment firm that has a very deep domain expertise in power. So M&A capability, project finance, legal, tax structuring, compliance, investor relations, and the like. And then the other half of the firm looks and feels like a power company or an energy company. An engineering team, power marketing team, energy management, fuel procurement, operations, or what we call asset management, regulatory policy, and the like. And it's the totality of this platform that allows us to do what we do, we think, very well. So as you would expect, with a platform like ours, we're looking for the more complicated value-added situations within our space. The opportunity set is very broad. It's the broadest it's been, the deepest it's been in my career. You know, for a long time, we were investing in utility-scale generation in a sector that was barely growing at the clip of GDP. You know, power demand had historically been highly correlated with GDP growth. And so from the 1990s till like 5, 6, 7 years ago, you know, we generated the returns we did by being very scrappy, being very operationally intensive, fighting for market share, and creating those kinds of outcomes. I think what you're seeing now is incredibly exciting because there's a broadening of the opportunity set as it relates to the energy transition. And there's also, we think, a virtuous cycle, a feedback loop that's going to increase power demand over time as you electrify more aspects of the economy. So the opportunity set is wider than it's been, it's deeper than it's been, and I think our platform is as strong as it's been to execute on it. And if you look at our information, you'll see we have a lot of domain expertise in investing in all aspects of the grid, from gas generation to transmission to solar to pump storage hydro, run-of-river hydro, wind, battery storage, across all the utility scale renewables, and then also distributed generation, EV charging, demand response, energy efficiency, microgrid. So I think we're one of the few folks out there that have actually been doing this for a long time. So we're excited about the opportunity ahead of us. We're excited about the potential to partner with you all. And with that, I'd be happy to take questions.
Do I have a motion?
Yes, Madam Chair. Based on the recommendation of the Council Investment Committee, Consultant Mercer, SIC staff, and General Fiduciary Oversight of RVK, I move that the State Investment Council approve a commitment of up to $150 million to LS Power Equity Partners 5, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Okay, we have a motion by Member Messina, second by Member Lavender. I hear Member Jennings on the line right now. Let's.
All right, Mr. Jennings.
Okay, yes.
All right, Madam Chair.
Yes.
Treasurer Montoya.
Yes.
Secretary Pop.
Yes.
All right, Member Tejas.
Yes.
Member Allen.
Yes.
Member Bingaman.
Yes.
All right, Member Lavender.
Yes.
Member Messina.
Yes.
Member Sommer.
Yes.
And Ms. Davis.
Very much, and thank you all from LS Power.
Thank you.
Thank
Appreciate
you.
it. Thanks, everyone.
Because we are still awaiting the impending arrival of a Bain representative, we're actually going to flip-flop I and J. So let's do agenda item 3J first. Blackstone Real Estate Partners Europe.
Okay, thank you, Madam Chair. We're here to recommend a commitment of up to $150 million to Blackstone Real Estate Partners 7 Joining me from Blackstone, Sarah Kendrowitz, Investment Relations, and an MD for the portfolio strategy, James Sapala. Do I have the name pronounced correctly? Yeah. Awesome, thank you. In terms of content for this presentation, the staff memo begins on page 664, consultant documentation on 666, and the GP's material on 705. Established relationship for SIC. This will be, this re-up will be the 7th investment in the wider Blackstone Real Estate Partners series of funds, and the 2nd in this European-focused vintage. Blackstone Real Estate Partners 7 is a closed-end, commingled, opportunistic strategy. Historically, management has targeted mid-teen returns using some amount of leverage. Because of rising financing costs, the use of leverage in this particular strategy is likely to be lower than previously. The expectation is that this reduction in leverage will not affect GP or LP returns. The financing environment is such that the opportunity to establish positions at deeper discounts than normal is a key driver for that differentiation. Blackstone's real estate playbook is a buy, fix, sell, so an LBO-like strategy in the real estate space. The goal is to establish positions in assets at a compelling basis, to triage the properties and businesses, and then ultimately resolve those issues to unlock value, and then finally to identify and execute against the opportunities set for exits. Blackstone favors real estate types where growth is historically and going forward expected to be strongest. Those in favor segments currently logistics, residential, and in Europe, leisure and hospitality, typically underweight in office and retail. And we expect that those will continue to be relatively small portions of the overall portfolio. Things that we like, Blackstone is Europe's largest landlord. The scale provides significant information advantages, which combined with Blackstone's access to capital, enable the agility necessary to build positions with limited competition. The opposite side of this scale advantage is the increasing challenge in finding buyers with sufficient means to fund the GP's exits. Blackstone has been able to mitigate this effect by breaking up portfolios for sale, executing smaller transactions, and that's been done successfully to date. On balance, Blackstone Real Estate Partners Fund Europe Series has generated reliable, consistent performance through time, particularly on a multiple basis where funds are consistently in the first or second quartile of all funds employing similar strategies. In part because of the GP's historical track record and strength of performance, fees tend to be a bit above market averages, and other structures are maybe less friendly than across other GPs. However, weighing the impact of those fee and other considerations, we find that the fund's performance is sufficient to justify the recommendation for a $150 million allocation. With that, I'll hand over to Steph just in case we left any details uncovered.
No, nothing further here. I know we've got Blackstone in front of you before. We're investing in the global fund, Asia and Europe, duration of the European.
Sure. Thanks. Thank you so much, and obviously thank you very much for your time today. My name is James Sapala, as Keith mentioned. I run the business in Europe. I've been focused on opportunistic real estate investing in Europe for 22 years now. We have been active in Europe for 26 years as a firm, and in that period of time, we've deployed about 33 billion euros of capital and have realized strong returns, a 17% net return, and as Keith mentioned, a high multiple of 2x multiple on our investor capital. And that has been, of course, during times of where the macro backdrop was relatively benign, as well as during times of dislocation. We're certainly in a period of dislocation now, and a little bit like has been produced for you in the context of BREP Europe 6, which is the fund that we're just wrapping up investing at the moment, which is tracking to about a 20% net internal rate of return. I would expect this next environment to produce outsized returns relative to what we have generated for investors over the last 26 years, because the environment is fraught with uncertainty on a macro perspective, volatility and dislocation, but it's those kind of environments where the scale of the capital that our LPs entrust us with and the scale of our team and some of the elements that Keith mentioned allows us generally to outperform. And we are seeing that real time. I expect that we're going to be wrapping up the investment period for Europe 6 in the next couple of months and probably turning on this fund immediately thereafter in conjunction with wrapping up Europe 6. And the environment in Europe at the moment is extremely fruitful. Since September, we've committed to over 70 transactions within European real estate, bought about 3.5 billion euros of assets or businesses at extremely compelling valuations. I think really likely to be one of the best vintages that I will ever, that I'll have seen in my career. And so I'm very excited to be here. I thank you very much, of course, for your time and for your trust in our business, but I'm also, very confident that we should be able to continue to produce really outsized returns for you. So with that, I'm very happy to open up to any questions you might have.
Questions from council?
Madam Chair?
Madam Treasurer?
I just had one question regarding the fee structure. And this is a public document. I think it's page 4. If someone can talk to me a little bit about the fee leakage and the unattractive fee structure and why we decided to go in that direction.
Is that page 4 of Townsend's report? Yeah.
I think it's 670 of diligence.
670 of diligence, that's correct.
Sure. So we described the fees in detail in the memo, and I won't put that on the public record, but the fees are, when you compare them to other opportunistic managers, they are above on the higher end. And it's outlined, on the reasons why being some of the promote structure and the overall fee load. What we think is mitigates that, and it's to the question directly. This is the offer on the table. It's a commingled fund that's looking to raise in the multiple billion-dollar commitments. So there's not much flexibility in the structure. But the mitigant being that is the consistent returns that Blackstone has generated and the cross-country exposure that you get from a diversified fund like this. There's very limited peers in this group when we're talking about the multi-billion-dollar European opportunity set. And in that peer set, Blackstone stands out at the top.
Madam Chair, I would also make a comment or an additional remark related to that, and that is that at the end of the day, we spend net returns, and the peer comparisons that we discussed, first and second quartile relative to Burgess on the relevant metrics, are on a net basis. So they're performing better than most people on the gross line, and it creates some opportunity to perform better on the net line despite the higher fee burden. And so we're looking at it on a net basis.
Member Alex.
Sort of an observation and a question. I just got back from a month in Portugal, half of which was in the Algarve in Tavira in the east. Fabulous country, fabulous growth. We were in Porto and Evora, and you said you're in the hospitality business. How much are you investing in Portugal, and how do you see that growth? I think they're like the 3rd or 4th highest growing company right now in the EU.
Yeah, so Portugal today, we've invested predominantly in logistics assets, which have gone very well. That's been a good market for us, and in effect in the lodging and leisure space. In fact, through BREP Europe 5 and BREP Europe 6, we're the largest owners of leisure resorts across the Mediterranean, so including Spain, Portugal, Italy, and Greece. And that's very much a theme that we're going to continue to focus on. And actually, we have quite an active pipeline in that space, including assets in Portugal, because ultimately, if you can buy high-quality assets that have been underinvested in over time, but that are in unique frontline locations, and you have the capital, and you can bring in, you can flag the properties in order to expand the distribution mix, then generally you can produce very, very attractive risk-adjusted returns for what's really irreplaceable real estate. And Portugal is very high up on that list in that context.
It was interesting because the infrastructure, the toll roads are fabulous to get you from, Northern Europe down to the Algarve in particular. But there were a lot of properties and meticulous beaches and it's an interesting area. I hadn't been there for 40 years and I was just amazed at the difference in the growth area and potential. And you, again, lots of businesses, distribution businesses and manufacturing there too. So interesting.
Absolutely. Portugal, Spain, Greece have all benefited, of course, from funds from across the EU. Greece, for example, the airports there have been huge beneficiaries of Fraport, meaningful investment from Fraport, for example. But the road networks across Spain and Portugal are dramatically different to what they were 20 years ago. You're absolutely right.
Thank you.
Madam Chair, based on the recommendations of the Council Investment Committee, Consultant Townsend, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $150 million it's really interesting. It says Bain, I'm reading it, it has Blackstone above and Bain down, to Blackstone Real Estate Partners Europe 7, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completions of appropriate paperwork.
Second. We've got a motion by Member Lavender, second by Member Messina. Discussion on the motion in front of us.
All right, Madam Chair?
Yes.
Treasurer Montoya?
Yes.
Secretary Propp?
Yes.
Member Tejas?
Yes.
Member Allen?
Yes.
Member Bingaman?
Yes.
Member Jennings?
Yes.
Member Lavender?
Yes.
Member Messina?
Yes.
Member Sommer?
Yes.
10 in favor, Madam Chair.
Okay. This is Tim. I'm gonna have to leave. I've got to go to a meeting with a prospective job organization here for Roswell. Thank you all very much.
Thank you, Member Jennings. All right, so next we're going to agenda item 3I, which is a real estate recommendation into Bain Real Estate Capital.
Madam Chair, thanks for your flexibility in the order of the agenda. Mr. Cotton's been playing planes, trains, and automobiles today based on weather yesterday on the East Coast, and so has just arrived in the nick of time. We're very appreciative of the effort you expend to be here with us today. We're here to recommend a commitment of up to $150 million to Bain Capital Real Estate Fund 3, representing Bain today, Tom Cotton, as I've mentioned, and Steve Radakovich. The materials for this presentation begin on page 603 from the staff memo perspective, 605 from Townsend, and 628 from the GP. In terms of New Mexico history with the GP, 6 prior investments have been made by the SIC with Bain Capital, including the recently approved Bain Capital Insurance Fund that Chris brought, I believe, last month. This will be the first investment by council in the real estate series. This fundraise is targeting about $3.75 billion, targeted net return in the low to mid-teens, and the risk profile will be opportunistic to value-added risk. Capital appreciation will be the principal component of returns. What we like about the strategy is it's just diversifying relative to the asset base that we hold currently in the portfolio. Historically, fund investments have included assets in self-storage, medical office, industrial infill, senior housing, life sciences, and lab-related space. We also like the pedigree of Bain Capital. The firm was founded in Boston in 1984. Currently, over 600 Bain employees manage about $160 billion in capital. Bain Capital Real Estate's 6 founding partners established the real estate platform in 2010. That was at the time called Harvard Management Company, and that group joined Bain in 2018. Currently, a 60-member team conducts in-depth research to identify the secular forces that will drive high-quality, long-term demand growth. It's a key driver of value creation in the real estate sector. We like the alignment between the GP and the fund. The fund is 100% employee-owned, and that enables the partnership to attract and retain high-quality talent in addition. Back to the idea of alignment, one of the things that we like is the GP commitment size is going to be quite large relative to what industry norms would be. In terms of underlying fund strategy, properties typically have a 5-year business plan that includes value accretive physical and operational improvements, as well as allowing for new development. Development risk is going to be capped at about 35% of the portfolio. The GP also seeks to capture a premium by aggregating smaller single property acquisitions into a portfolio and selling those larger portfolios once they've attained scale to capture the portfolio premium. The fund, together with its operating partners, fields about 120 members, sourcing team, all with significant experience in the distressed market conditions that we're currently seeing in the marketplace. We believe that these conditions will cause this vintage to be a potentially very strong performer. The series' first vintage was in 2018 and is the only one with meaningful realizations to date. That fund was marked year-end at a high 20s IRR and a 1.5 plus multiple, representing strong first/second quartile performance. We've also evaluated the team's track record as a captive within Harvard Management Company. Those numbers also, as you would see in the staff memo, contribute to the strength of the underlying story. Given the balance of the fund's benefits, costs, and risks, we're recommending, again, a $150 million allocation to the Bain Capital Real Estate Fund. Seth, would you like to make any comments before we hand over to Tom?
Just one. So I think that Keith described the strategy as sort of these non-traditional property types, alternative property types. We see this as a tremendous growth opportunity within real estate. We know that we'll talk about our performance report shortly, that office and retail have been sort of the dogs of the traditional property types, and then that leaves multifamily and industrial as being the only other primary property types that have really gained a lot of uplift from returns. But these non-traditional property types that Bain seeks is really becoming more institutional, and this is a group that obviously focuses almost primarily on those property types.
Thank you, Mr. Sable, Mr. Marcus. It's a pleasure to be here. My name is Ryan Cotton. I'm the managing partner of Bain Capital Real Estate. I have over 20 years of experience at Bain Capital, and on behalf of all of my partners, it is a privilege to work for you all and an honor to be here today. Thank you. At Bain Capital Real Estate, as Mr. Sable said, we pursue a value-added plus strategy aimed to differentiate ourselves through our sector selection and our value addition. We differentiate ourselves on 3 principal axes. The first of those is by being rigorously thematic. We study underlying consumer behavior changes, changes in technology, changes in capital markets to identify sectors where we think there is excess return potential within real estate. That leads us into spaces, as Mr. Marcus described, like life science lab space and infill industrial assets, and most importantly, that has led us away from assets like offices and retail. We do not own a single office building, and that's not by accident. Once we find those thematics that we believe have multi-year tailwinds behind them, we go about building captive operating platforms exclusive to us to go prosecute investing in those thematic areas. Those platforms are built around the principal axis of competitive advantage within that thematic. For life science lab space, that may be brand and product design. For infill industrial, that's local market scale and the markets we choose to operate in. Given that advantage, we believe we can source better, lease better, and value add better than other competitors in the market. And lastly, we differentiate ourselves through dynamic discipline. We do not operate an always-on model. We don't believe it is our job to invest a consistent amount of money in every asset class in all seasons. We believe it's our job to leverage our thematic expertise and the market knowledge we have to find moments where it's attractive to attach our capital and moments where it's wise to step back and let the market be. In our largest strategy of life science lab deployment, 2022 was the biggest ever year of capital deployment for the industry. It was our smallest year of capital deployment. We didn't like the pricing environment around us, and we allowed other people with less experience to do those transactions while we waited for better days, which we're starting to see now. We're highly confident the market that's evolving around us is going to present a unique opportunity for us. With a very healthy portfolio, captive in-place platforms ready to act in our high conviction sectors and strategies, and the track record of experience we have in these distressed markets coupled with Bain Capital's platform advantage in special situations and distress, we think we can produce some pretty extraordinary returns in the vintage to come. Thank you so much, and it'll be a pleasure to take your questions.
Madam Chair, I have one question.
Yes.
Good morning, sir. Thank you for being with us today. It was mentioned that we've worked with you in the past, but in a different realm. Can you tell me how long you've been working in the real estate realm and any type of information that would be helpful on the real estate aspect of it?
Sure. So Bain Capital has a deep relationship with the council in our private equity funds, and we appreciate your support there. I myself have been the architect of Bain Capital's real estate strategy for over a decade, dating back to the global financial crisis. I architected and designed the white paper for the products we would build in real estate and the way we would go about that market. And I helped attract the team from Harvard Management Company that Mr. Sable described in 2017. I joined the investment committee of those funds in 2018 and managed the team in partnership with my now retired partner, Dan Cummings, for the last 5.5 years.
Thank you, sir.
Further questions?
Based on the recommendation of the Council Investment Committee, consult with Townsend, SIC staff, and general fiduciary oversight of RBK, I move the State Investment Council approve a commitment of up to $150 million to Bain Real Estate Capital III, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I will second the motion.
Okay, we've got a motion by member Lavender, second by the treasurer. Any discussion on the motion before us? If none, we'll take a roll call vote.
Madam Chair?
Yes.
Treasurer Montoya?
Yes.
Secretary Prost?
Yes.
Member Tejas?
Yes.
Member Allen?
Yes.
Member Bingaman?
Yes.
Member Lavender?
Yes.
Member Messina?
Yes.
Member Sommer?
Yes.
9 in favor, Madam Chair.
Thank you so much, and thank you for making the effort to be with us in person and face the fire and have a great result.
It's a pleasure to be here. Thank you for your support.
All right.
Love to work for you.
So we actually, that concludes our investment votes. We do have 2 more votes, after which time I'm just gonna have a brief recess because I've been a captive in this seat and get out of it. So let's go on to agenda item 3L. We're gonna hear from Mr. Cassidy on pitch book data.
So this is more of an administrative item. This is PitchBook is a data service that basically has a database of transactions in the private market. This would just be a resource for staff. They're particularly good on the venture capital side in terms of the data they collect. So this a recommendation for the subscription.
What are the costs?
$40,000 a year for 5 people.
Member Messina.
Yes. Based on the recommendation of the Council Investment Committee and SIC staff, I move that the State Investment Council approve a subscription to PitchBook Data Inc. as memorialized and discussed at today's meeting.
That is a subscription of $40,000 for 5 authorized. Is there discussion?
Yes, Madam Chair, just because I'm new to the council, why would a matter like this come before us?
Approximately 13 years ago, or any of us were here, I guess any of the council members as well, council reactively decided that for any item over $50,000, or this would be at more than 4 years, come to a council for a vote. It kind of dovetails with what Vince was talking
secretary to consider it added.
All right, we've got a motion, folks.
You don't have a second.
I'll second.
Okay. Motion by member Messina, second by member Lavender. Any discussion on the motion?
All right, Madam Chair?
Yes.
Treasurer Matoya?
Yes.
Secretary Pop?
Yes.
Member Tejas?
Yes.
Member Allen?
Yes.
Member Bingaman?
Yes.
Member Lavender?
Yes.
Member Messina?
Yes.
Member Sommer?
Yes.
9 in favor, Madam Chair.
Thank you so much. Thank you. All right, we're going to move on to agenda item 4, and I'm going to ask our CFO, could you just do your report and then move into the office lease renewal, do those two rapid succession?
I'm happy to. As I typically do, I've provided the budget to actual through the end of May for your review, as well as the investment holdings report. I did want to mention, because there's no meeting in July, the next meeting that we'll have in August will actually be in the new fiscal year. So this will be the last budget to actual report that you actually see. Other than that, I just wanted to let everybody know on the agreed upon procedures report, there is one due at the end of June. I should be distributing that within the next several days. I got a draft of it yesterday. It's under review. Once it's finalized, we'll distribute that to everyone. And then finally, the lease renewal that is before you, it's the second of 2 5-year terms. This is the final option that we have. I have found the terms very consistent with what we've had in the past. Relative to the original pricing and the original lease some close to 15 years ago, we're about 5% below the estimates that were in that. They did price up some adjustment relative to the expiring 5-year lease of about 2%, which I found very reasonable. And other than that, I'd just like to say again, this is the last of the options that we have for our current building. After this 5-year term, we would have to consider either a new lease from the start or consider additional or new space. And that's all I have, unless there's questions.
Questions from council?
I'm glad to do another one. I go for the gentleman.
Got member Summer.
Yeah, well, I was gonna say, Kurt, you wanna do this?
Yeah, well, I have a question about space. Given what's being projected in terms of needs for staff and the space that you're currently occupying, is this gonna work? Does it make sense? Should you be looking at other space? I'm hearing need for more people. Does this make sense?
That's, Mr. Sommer, that's a very good question. We think over the next 2 to 3 years, the current space should be adequate. We might very well have to change some things as to how we operate within our current building. And then an added addition to your question, we are considering in the near term other options to augment this space. So where that ends, I don't know, but I think for the 5-year option that we have right now, it makes sense certainly within the next 2 to 3 years, and then we might have to do some things with cubes and other things because everybody in the current space has an office. I'm not so sure that's going to be viable going forward, based upon some guidance that we've got from GSD regarding allowed square footage per state employee. So we're going to be changing some things in the future, and we're looking to possibly augment the space as we look right now.
Madam Chair, I'm questioning though whether it makes sense to commit to a 5-year term when it may not be necessary if you commit to a 2 or 3 year term and look at other options.
And
I'm raising that based on what Councilman President.
Yeah. Mr. Summers, the other thing that we did ask on the pricing here on the current lease, we did originally ask for a 3-year commitment with the remaining 2-year option, and the building owners and their bankers were unwilling to do that. And because of that, we thought it was probably best to go forward with the 5-year. It's certainly open to discussion. I also want to make it clear to the council that the current lease expires, the current option expires, or I should say lease, the current term expires at the end of July. And you might wonder, well, why is it being brought right now? We've been working on this for probably 8 months. We have to involve GSD. There were some delays there. They have to approve everything. Any additional space that we would consider in the future, they'll have to approve. So there's other entities that we've had to get involved with this decision. We think it's doable within the next 3 to 5 years. Although, as I said before, we're probably going to have to revamp some of the office settings that we currently have in the building that we're in.
Madam Chair, what is the cost for the lease per year?
If you look under proposed, you can see the pricing for year 16, 17, 18, 19, and 20. The total commitment over the 5 years is close to $1.6 million. So it's a little over $300,000 per year for the current space that we have.
And Madam Chair, that's including the 3% decrease from the current lease?
Actually, if you look right above the proposed column, the current year is $303,000, so it just ticked up just about, I think about 2% over what it is right now, which relative to what is happening with inflation, we think that is reasonable. And then on the far right-hand schedule, that statement that you have in front of you, you can see in the original lease term, they've marked down the renewal cost by about 5% over what was in the original lease document.
I'm sorry, the reason why I was asking is because I couldn't find it in the packet, which page number you're on.
Madam Treasurer, it's page 817.
Thank you, sir. If you're ready for a motion, I'd be happy to do it.
Sounds great, Madam Chair.
Thank you. Based on the recommendation of the SIC staff, I move that the State Investment Council approve renewal of the SIC office lease under the terms memorialized and discussed in today's council meeting.
Second.
Okay, we've got a motion by the Treasurer, second by Member Lavender. Any discussion? Take a roll call.
All right, Madam Chair?
Yes.
Treasurer Montoya?
Yes.
Secretary Pop?
Yes.
Member Tejas?
Yes.
Member Allen?
Yes.
Member Bingaman?
Yes.
Member Lavender?
Yes.
Member Messina?
Yes.
Member Sommer?
Yes.
I'm in favor, Madam Chair.
Okay, great. Now, we are going to take a 5-minute recess as of this time. We'll be back according to this clock here, 10 here, and just so folks know that I'm not wasting their time, you know, I have to go all the way around half this building to my bathroom. And then be let back into the cabinet room, I mean, it's a whole deal. So I'm not like, you know, I'm not dilly-dallying. All right, so we're gonna go now to agenda item 2C, and we're gonna hear from, Vincent RDK on the April.
Well, Madam Chair, I'll just turn right to RBK. We've got an interim report for you, just one for April. So we normally spend our time on the quarterly, but we do like to update on a monthly basis. One thing you will notice in this report, as you had in the last couple, we've really got some catch up on our benchmark relative. So we're ahead of almost all benchmarks, all time frames now. So a nice little catch up through 22 and first part of 23 here.
Great. Yeah, thank you, Madam Chair. Thanks, Vince, for the comment. Not too much has changed in terms of the macro environment, as Vincent mentioned from our report last month. We do have the April performance summary up, which, given that it's not the middle of the quarter here, we don't have the updated valuations for the private markets, but nonetheless, are pleased to report on the publics, which, to Vince's point, particularly on a relative but also absolute basis, are trending in the right direction. You can see in the bottom right-hand side, there's a market performance for the most recent period. We'll just focus on month-to-date, although try to give you a little bit of sense of the more near-term data as well. So you can see more mixed results, but generally trending favorably, trending up. Inflation has been a key topic for a number of quarters now. Obviously, a lot of common themes into our capital market expectations and forward expectations as well. That number remains quite elevated, although it's been trending down 5% at the end of April, and it's been trending further down to 4%. But we still got some ways to go there and see if it actually sticks, or if some of the more sticky parts of that will continue to be potential headwind for some of those impacted asset classes. And
what page number are you on? Sorry for interrupting.
Oh, no problem. Yeah, page 22 of the board materials and page 2 of our report. So this is which provides essentially all of the overarching statistics in the market there. And so one of the big changes here was the Fed actually pausing, not necessarily lowering, but even just pausing provides a bit of relief, although it doesn't necessarily provide any stimulus. It just means that gives you more time for some of the prior hikes to really take effect. And a lot of these are happening on a lagging basis anyway. So the Fed is trying to thread that needle right in terms of continuing to get inflation down, but not throw us into a violent recession. And so we'll see how that goes. Across the risk assets, when you're looking at the first 4, 5, or 6 lines there, those are your equities. You can see that you're starting to see more pronounced differences, so across style, size, but also geography. We've talked about that U.S. and non-U.S. has been trading back and forth in terms of market leadership there. One of the things that's been interesting this year, and it's been prevalent really all throughout this entire time here, calendar year to date, market leadership has been very narrow. There's been just really a few names, 7 or so. Previously, you talked about the FANG stocks. Now it's similar, but some slightly different constituents really driving the entire market gains that we've seen, and that's typically not a terribly strong sign of a healthy market. Typically, like to see broader participation across the stocks in the index, and so those 7 stocks are up over 80%. The rest of the market is fairly positive, so it just shows you how differentiated the returns are across those positions. And also, of course, that means when those few names are not performing, we're seeing a little bit of that this week, then things can go the other way. The last comment that I'll make is just some fixed income. We've seen some positive numbers coming off of a very difficult 2022. Rates have moderated some. April was still positive, although the second quarter, as rates have continued to
trend a little bit higher. You can't see that here because the yield curve that we're showing is as of April through May and June has continued to move up a little bit. And so fixed income has come under pressure, but still nowhere near what we were seeing last year, and overall still accretive to return. So happy to take any questions or comments. Otherwise, Marcia's going to give you the fund.
We're going to go to page 24. And at the bottom of the page is the performance through April. Again, this is a monthly flash. So as Matthias said, it does not include private marks. Interim quarter months are held at 0 for private. So this is reflecting mostly the public assets. So for the month of April, you were up in total 0.72. That translated to 0.79 up for land grant, and the severance was up 0.72. As Vince mentioned, longer-term numbers you're seeing some outperformance pretty much across the board except for the 3 and 5 years. So the longer term you have outperformance, and shorter term fiscal year to date, you are too small for my eyes, 5.2 for the total, and 5.71 for land grant, and a much lower number, 4.66 on a fiscal year to date for severance. The next two pages, 25 and 26, we typically spend a little time on these. These are looking at asset allocation versus target. Remember, your asset allocations have changed. These reflect the old asset allocations. And then in August, we'll be talking to you about interim targets, because many of these funds had some pretty significant moves, and you don't want to go all in at one time. You want to gradually move to those targets. So Vince will be talking to you about interim targets. Not even reflecting some of the new money coming in. If you go to pages 27 and 28, you can see calendar year to date, beginning values and ending values and net cash flows and gains on a calendar year to date basis, showing again those very strong net cash flows. The following page, on page 28, the only two funds that had a negative cash flow were water and rural libraries. And again, these do not reflect some of the new decisions that were made. I'm now just going to take you to the composite performance. This is on page 30 of Diligent, again at the top showing those returns for the total fund and then land grant and severance. So if we look at the asset class composites, you can see outperformance near term on U.S. equity and on non-U.S. equity, both positive for the month and both relatively strong fiscal year to date. I would say strong, with non-U.S. doing better than domestic on a fiscal year to date. On the core fixed income side, again, positive returns, and for the short term, outperforming their benchmark. There's just one calendar year to date where you're slightly underperforming, but the track record there is a nice outperformance on core fixed income. Non-core fixed income, this is for this short term period, actually trailed core. But if you look longer term, having the non-core fixed income, which soon will be named private fixed income, has been very additive for you. Cash, and then on the next page, you'll see a lot of zeros because these are the private. One comment I want to make, and we go through this, but this kind of ties, I believe this ties to what Vince was talking earlier. Page 32. Each report we show you attribution. Where did your performance come from? And we say all the time, the biggest driver of return is asset allocation. Next after that is how you structure each of those asset classes to fit your asset allocation. We'd like to have outperformance from managers, but that's not your biggest driver of return. But that's where you're spending most of your time. So again, talking about asset allocation with the annual plan, listening to your asset class directors and how they're structuring those, and then also understanding how they're picking the manager. Those are the, from the top to the lowest impact on your return. And with that, we'll take any questions you might have.
Secretary.
Thank you, Madam Chair, members of the council, and maybe Ben can chime in too. You mentioned this, Marcia, and I've heard this before. What's kind of the rule of thumb in terms of asset allocation versus manager selection in terms of?
90%. Studies say that you can attribute 90-ish% of your returns to the decisions on how you're going to diversify your asset class.
As opposed to selecting managers.
And then second after that is how you structure those asset classes, because you're modeling asset allocation. You want to structure each of those asset classes in an advantageous way. And then lastly, manager selection. Thank you.
I would concur. There's several studies, academic studies. They run from 70 to 95%. Down on the lower end, it's usually a definition problem. So to me, when I read those studies, they're getting some asset allocation effect, manager effect on the ones that are toward the lower end. But it's clear, allocate your assets right.
Now, the good news is, for the month, your managers added value, and on the next page, they added value for the 1 year number 2. So that's great. But the biggest driver is the blue line, which is your strategic asset allocation. Madam Chair, we'll take any questions. Thank you.
Madam Chair, if I could just one comment, I'm sorry. Marcia didn't highlight it, but we still have a lot of cash on our balance sheets. A lot of the inflows, it's just really difficult to have portfolios in the private markets. It's difficult to get money over, incremental money over to that side. You've seen our pacing models blow up. There's a presentation today on how those pacing models have really jumped up. This might sound weird, but it's okay. We're getting around 5% on our cash these days. And we're not doing much more than that in the portfolio as a whole. So there's not a big drag from having the cash on our balance sheet as it would have been 2 or 3 years ago when cash rates were less than percent.
I move to our Q4 report. Thank you all.
Thank you.
We start with, real estate.
Okay, I'll jump right in with some introductory commentary related to the fourth quarter PMR with respect to real estate. For calendar 2022, we lagged by 60 basis points on a net basis, but for longer horizons, 3, 5, and 7 years, have outperformed by at least 160 basis points net annualized. Key drivers over the course of calendar 2022, large rise in cap rates that were driven by the move in shorter-term interest rates. The rise in rates and changes in valuations also have caused a tightening in terms of credit conditions in the market. So that's making refinancings difficult for a number of real estate properties. On balance, valuations are under significant pressure, and that's most easily seen in the performance of the public REIT market indices that are down double digits on calendar 22. In terms of operating performance, strong trends have continued, and weak trends have continued. So NOI growth in sectors like industrial, multifamily, for example, have continued to be quite strong. Retail and office have continued to be particularly weak. In terms of looking ahead, core real estate valuation is an appraisal-based process. That makes it relatively slow to adapt to the market changes that I had just described. I think the reality is that current valuations are still not fully reflecting the reality, and so on balance, we're expecting some negative returns going forward in the more immediate term, where those NOI growth trends will probably persist to the positive side, but valuation changes are likely to offset much of that benefit. In terms of non-core sector, valuations tend to be a little bit more sensitive in terms of time frame to changes in conditions. So the marks there are a little bit more conservative on balance. You see the stresses that are prevalent in the market creating a lot of good capital deployment opportunities, and that's a key fact behind the recommendations today for Bain and Blackstone and earlier to Oaktree. With that, I'll hand over to Seth and Rob.
Great, thanks. So good afternoon now. So I'm going to walk through the real estate performance report. Rob's going to talk through the real return. We'll keep our comments brief. The materials in your book are also a little bit longer because of us. So as some of you know, on an annual basis, we produce a single-page review of every investment that we cover within the real estate portfolio and the real return. So it's 61 real estate investments, 35 real assets. So we're not going through those today, but they're in your book for your reference. These summaries include further snapshot of the fund strategies, the individualized performance and funding status, diversification, and some attributes of those funds. And I had given a brief overview, sort of a market commentary in the CIC. I will omit that today and just sort of walk through the portfolio on page 52 of diligence. So as Keith mentioned, this data is as of the fourth quarter of 2022. This is the second consecutive quarter of negative performance on an absolute basis from the real estate portfolio. But again, did outperform on a relative basis to the Odyssey Index by about 230 basis points during the quarter, and then led to a small underperformance that Keith mentioned of about 60 basis points over the 1-year period. This was 180 basis points of underperformance last quarter, so we've shrunk that gap there. This led to a smaller amount. This is again on page 52. So the portfolio does outperform over the longer term. So we really look at things over the 5, 10, 7-year return time frame. Our policy benchmark is 5 years. We do outperform over those time periods, and that's really how we should be evaluating real estate, right? The short-term volatility in the portfolio is not, still maintains a long-term outcome. So the short-term negative performance did drive that 1-year return. If you recall, the 1-year return just last quarter, so when we looked at 4 quarters ending third quarter 2022, was 19.2%. Roll forward just 1 quarter and we're at 6%. So that was a big adjustment, right? When we dropped the quarter of 2021. 2021 was an anomaly, north of 20% return for the portfolio. Now we're looking at a 6% over the 1-year period, much more in line with historical context and long-term returns. And the value adjustments have really coincided with the broader market disruption and the rise in interest rates with the index return. Historical norms for real estate is to generate about a 7 to 9% return, with about 2/3 of that coming from income. You'll see that number over the 5 to 7-year time frame, both in our portfolio, exceeding that, and then also in the benchmark index. Our outperformance is really driven by both investment selection as well as allocation, and we just talked a little bit about that with RDK. But an overweight to core, and then industrial and alternative property types, those 3 are the main drivers of the returns over the long term. We note in our report that in 1Q, so we do have the 1Q numbers for the index, not necessarily for our full portfolio, we do anticipate another negative return and most likely another negative quarter in the second quarter, as we're wrapping up here at the end of the month. Sort of in the negative 3% range for each quarter. Again, valuation lags in real estate tend to be about 12 to 18 months from the public market, and we think, if you head back 18 months, we were seeing the negative returns out of the public market. And then the other slide I wanted to mention was one I've talked about in the past, 53. Here we started to highlight the consistent and strong income component of the return. I mentioned 2/3 of our return typically comes from income. Here we look at it on an annual basis and then on a relative basis to the Odyssey, regardless of what is happening in the broader market, right? You see in 2008, 2009, that was the global financial crisis, those negative returns, or it's called depreciation in the portfolio, but positive income. We saw the same thing quickly and short-lived in the COVID environment. But our income has been consistent, and that's really where we're driving the value return in real estate. And then the last slide, jumping ahead to 57, is the public market equivalent. We talked about this historically in a lot of different contexts, but here we're showing it both on the since inception of the total portfolio back to the original first commitment made, and then since 2011 when we sort of initiated the new portfolio structure. You see the wide variance here in the outperformance of the real estate versus its public market equivalent. You'll see this gap shrink as the public markets have obviously done well in the first 6 months of this year. And real estate, as I mentioned, has some negative returns. So you'll see this gap shrink, but it is still significant when you look at a public market equivalent to the value being created out of a private income. Those are my prepared remarks. I'm happy to answer any questions.
Are we going to take questions on real estate before we move to real return?
All right,
So to jump in real quickly on the real assets, real return portfolio, it's lagging the CPI plus 300 benchmark on a 5-year basis, but real assets has outperformed by 580 basis points and 300 respectively in the last calendar year and last quarter. Real assets positive returns in 2022 calendar year were a beneficial diversifier to the funds overall. Much of the real asset portfolio is sensitive to energy prices, both in terms of MLP and then midstream assets that are held in other parts of the portfolio, as well as energy-related infrastructure. Traditional infrastructure investments are characterized by inflation-linked revenue streams, volumes that are tending to be less sensitive to GDP variability, and they also benefit by the long-term financing arrangements. In a rising rate environment, those liabilities get marked down, and it tends to provide a tailwind to NAVs in the funds. And so those have been the summary of the key drivers we've seen over the last 12 months. Rob.
Great. It's nice to be here, everybody. I'm Rob Coaches. I'm a partner at the Townsend Group. I've been working with Seth on this program for the last several months as we kind of staff up, given the growth of the program and the increased investment activity. We've got about 50 pages of real return material in your book, I should say. I'm going to cover, I think, 7 slides, so I'll run through those very quickly. Starting on page 147 of your material. Real return is you have a 10% target to real return across your funds. Right now, the net asset value of that portfolio is about $3.1 billion. This is all as of December 31, 2022. We're about 90-day lag in our performance reporting, so we don't have our quarterly numbers in as of March 31 yet. Just to break real return down, and it's a little bit confusing because the terms are similar, but you've got real return, you've got real assets. I like to think of real assets as basically investing in hard assets. So those are mostly private market investments that focus on hard asset-backed investing. So outside of real estate, that includes infrastructure, energy, timber, agriculture. There's also a 20% slug of your real return portfolio dedicated to financial assets. And that includes your public MLP portfolio. These are really publicly traded stocks, although they reflect energy infrastructure. And your debt-oriented investments in this portfolio, which aren't really hard asset investing per se. Those are lending opportunities. The key to all of this is it's supposed to be an inflation hedge, and it's supposed to be a diversifier for your portfolio. And so if you turn to page 148 and look at the performance, it's interesting because there's been a lot of commentary today from the staff and the investment plan about diversification. And you can see that between the real estate returns and the real return portfolio over the last year especially. In fact, real return returns spiked in 2022. You had over a 15% net return in real returns and strong performance out of all of these sectors during the tail end of 2022. So while real estate was adjusting to the interest rate environment, real return was adjusting to other things like inflation, perhaps the war in Ukraine, helped boost up agriculture and energy in particular. But really, real return across the board, you had solid returns in 2022. Over the 5-year period, the program is underperforming its benchmark, which is CPI plus 300 basis points. But over the long run, the program is about 300 basis points, actually 400 basis points above its benchmark since its inception. So you got a dip related primarily to energy volatility over the last 5 years that have impacted the performance. I'm going to skip ahead to page 151 in your materials. And just to talk a little bit about the program and how it's been built, this focuses on the real assets, the 80% that's focused on hard assets, private market investing. And the real assets is about $2.5 billion of your funds, 8% target allocation. And you can see the history of building this portfolio over the years. And I guess general comments is that you've taken a very thoughtful, methodical approach to building the program. We would say you have good vintage year diversification. You've done roughly 4 to 5 investments per year, $300 to $400 million committed per year. You see the spike in 2022 and 2023 as the investment level picked up. In fact, in 2022, you invested $650 million over 6 investments. So that investment activity is really picking up, and you're going to see those numbers, and that was in the presentation on the pacing earlier today. You're going to see those numbers pick up. skipping ahead to page 152, just the next page, 152. Performance of the real assets, this is the 80% of the real return portfolio, mirrors what's going on in the broader real return portfolio with strong results in 2022, especially at year end 2022. But you still have that lag in performance over the last 5 years. But over the long run, the program has exceeded its benchmark performance since inception by over 600 basis points since 2011. Part of returns is cash flows, and I want to skip ahead to page 157 in your materials because I think this is a good, just a good illustration of cash flows out of real return and similar to real estate. But on this page, we show how your market value changes from quarter to quarter and the different components of things that add to or detract from the market value of your real return portfolio. And a couple of comments here. One is as the program has been funding up, you funded almost $80 million of investment in just the fourth quarter of last year alone. You also had about $50 million of sale proceeds, profits, and money coming back from your investment in the fourth quarter of 2022. So the point of that is you've got to constantly recycle and reinvest that money, and as you're growing your allocation over time, it means the investment level activity obviously has got to pick up if you want to build that net asset value. Another point that's important to note is, and this goes to Vince's comments about compounding over time, you had about $90 million of appreciation in the fourth quarter alone. So that's just building up that asset value, the value of the investments increasing, and a nice big appreciation gain in the end of 2022. Yes. Pardon me? Cash flow. Oh, I'm sorry. I want to finish up and talk a little bit about diversification of the program. One thing you're seeing is the infrastructure piece of real assets more or less be more dominant in the program. We think that will smooth the performance over time as the energy slice of the pie decreases, infrastructure increases. You'll get a little bit more stability out of the infrastructure piece of your program. The two pie charts on page 158 in the materials is kind of on the left-hand side is where you were at December 31, 2022. On the right-hand side is where you're going, the exposure level in terms of both your current invested value plus what you've committed that is not yet funded. And you can see that the infrastructure slice of the pie there is growing. And at the same time, timber and agriculture are becoming a smaller part of the program. Part of the reason is that those are very small segments of the investable universe, and it's really hard to scale up in timber and agriculture. So you'll see probably those stay about the same or continue to shrink over time as you grow the portfolio. And finally, on page 150, actually I got two more slides to cover. 159, very quickly, the vast majority of your real return is invested in the United States and other developed markets around the world, almost 80%, actually over 85%, I should say. You've got about 16% of the real return portfolio exposed to primarily agriculture and timber investments in Latin America. But it's predominantly, you're invested in good, solid, developed markets, less volatility there, and dominated by your investments in the United States. And finally, we do track compliance of your program with the internal guidelines that you're pursuing as you build the program, and a couple of compliance notes. We mentioned the performance. Right now, that's the bogey we're shooting for, is kind of consistently beating CPI plus 300 over 5 years, and over the last 5 years, the program did not do that because of the energy volatility. And the second thing is the infrastructure program is actually above its kind of target maximum, which is 50% of the program. That's a product of both a better set of opportunities to invest in, so more commitments have been made in those sectors recently, and the performance has boosted the asset value of that portfolio as you've invested up and gotten some good appreciation gains there as well. So right now you're slightly above your 50% max, if you will, in infrastructure. over time, those numbers are gonna change dramatically as this program.
Assets buckets where the MLPs are, that's a significant amount of energy related infrastructure, and that doesn't get rolled up into the sector breakouts that you see in the real asset piece. One of the ideas that we're looking at in terms of a structure study going forward, the sector exposures are of all the underlying assets and group them in a way where we have a single common denominator across all of them. When we take those steps into account, the infrastructure weight at this point would be below that threshold.
With that, I'll end there and take any questions.
All right, thank you.
Thank you.
Highlight of the meeting, Brenda. We're going to hear from Don Iglesias on agenda item 3D, intergeneration.
Thank you, Madam Chair, council members. We will be on the intergenerational equity study. That's going to be on page 274 of your diligent book. And I know we are running over today, so I'll try to be brief. I promise I'll only take about 10 minutes, but I want to make sure that I hit all of the highlights of the report, especially those that are important for understanding the context of this report and are particularly beneficial for interpreting the outcomes. So as a quick refresher here for page 274, the intergenerational equity study, it looks at the fund's spending policies, the investment return expectations after accounting for inflation, and the policies for contributing monies into the funds. Each of these items plays a role in the analysis, and you'll see in the report that the inflow expectations are having an outsized effect on this year's intergenerational equity scores, which are in the 80s to 90s for all of the funds that we've looked at, so land grant, severance tax, and early childhood. So relatively high scores. But before we get to that, the first thing that I want to do is make sure that we have a really good grasp on what exactly is the intergenerational equity objective. What is it that we're trying to achieve here? And then what exactly are these results telling us? So looking at the definition on page 3 of RBK's report, that's page 275 of your diligent book, focusing here on items 1 and 2 on the definition of the intergenerational equity objective. So the IE objective is to ensure that distributions to beneficiaries will be worth at least as much in the future as they are today after adjusting for inflation and potential population growth. So are future generations getting at least as much value from distributions as current generations? And the scores themselves are simply a probability of achieving that objective. So in other words, what is the probability that the funds will be able to maintain their economic value over time? So rather than focusing on a particular score or particular number, what we should be looking at is what the scores are telling us. And the question we should be asking is whether that score is directionally consistent with the implicit and explicit goals of the funds. So the scores for the current studies, which are all in the 80s and 90s again for the funds, tell us two primary things. The first is that there's a very high probability of achieving the objective of maintaining the inflation-adjusted value of the benefit. That's what, so for land grant fund, the score is 86.2. So what that means is an 86.2% chance of maintaining that inflation-adjusted economic value of those benefits. The second thing that it tells us is that the value of those benefits are likely to grow over time. And the reason for that, once we've dug into this study, is primarily because of the strong inflows that we're expecting over the next several years. So if you turn to the next page, 276, you can see that the cumulative expectations for the land grant fund are nearly $15 billion higher in inflows than what we were looking at last year. And about $20 billion higher cumulatively for the severance tax fund. Now, this is a function of a few things. One is just more precise modeling of the inflows. A second thing is the price and production expectations that we went into the inflows analysis earlier today. So we have a very different forward-looking outlook than something that we've seen in the past. And the third thing, particularly for the severance tax permanent fund, is that there was legislation that was passed that will deposit brand new sources of funding into those funds, and those are expected to be very large. And this year we found that changing this inflow assumption was the single biggest driver of changes to the intergenerational equity score. And of course that's going to make sense, right? Because if you're depositing more money into the funds than you ever have in the past, then those funds are going to distribute more money into the future, all else equal, at least. So another thing to keep in mind about these scores being really inflow-driven is that if inflow projections were to come down significantly in the future, say it looks like the energy transition is going to be more accelerated than what we have in our current baseline estimate, for example, then these scores could come down pretty dramatically as well. And that could mean what would happen if that score comes down, what that would mean is we would go from a high probability of achieving the inflation-adjusted value to potentially a low probability of achieving that value. So it's just important to keep in mind what the changes in the scores mean, and then how the changes to the inflow projections could potentially affect that going forward. The second thing that I really want to make sure I highlight for this study is for interpreting these scores, it's important to keep in mind context. So specifically, recognizing the reason for why these funds are getting more inflows than they ever did before. For example, the severance tax fund. The reason it is getting significantly more inflows is because the legislature made a deliberate decision through Senate Bill 320 or through Senate Bill 26, and also through its one-time appropriation, and also through the additional $92 million it'll be depositing over the next 10 years. It made a deliberate decision to say, let's invest windfall oil and gas revenues today for the specific purpose of growing the distribution from the fund in the future. And we saw this highlighted in LSC's post-session report, where they say that the legislature wants to use higher distributions from the permanent fund to hedge the risk of future declines in oil and gas general fund revenues. So in this case, you want to see a high score because essentially, the passage of those pieces of legislation is a directive to grow the economic value of those benefits, and a high score is therefore consistent with that goal. It indicates not only a high probability of maintaining today's current value, but also a high probability of increasing that value over time. So we want to see a high score for that, and we do see that in this report. Similarly, you could make an argument for the land grant permanent fund of a similar nature. So LSC presented a report last July to, the staff presented to the LSC that the future declines in oil and gas revenues to the general fund could erode general fund growth in a way that could make it difficult to maintain current levels of government services. Well, that matters for our beneficiaries for the land grant permanent fund because their budgets are developed through both land grant permanent fund distributions and general fund dollars. So if the real value of revenues are expected to decline over time due to declining oil and gas revenue, then growing the value of future land grant permanent fund distributions could help offset that risk of potential declining oil and gas revenues into the general fund in the future. And if that were the intent, then similar to the severance tax fund, you would want to see a high IE score to show both the probability of maintaining and increasing the value of those benefits or those distributions over time. And the last couple points I'll make are on the early childhood fund. So first, the legislature has signaled a strong desire to increase funding for early childhood programs. So a high IE score like we see in this report today, at least in the near term, could be warranted to help meet that goal. And then the second point is a mechanical one. So distributions from the early childhood fund are based on a 3-year average of the fund's value. And because the fund is relatively new, that average has yet to fully incorporate the very sizable contributions that were made last year, the sizable contributions we're expecting this year and over the next couple of years. Now what that means is that once the low NAV years of the fund drop out of that average, the dollar amount for that distribution jumps up, and therefore it makes the bar for maintaining that level of distributions a lot higher. So to illustrate that, I'm going to jump forward to page 289 of your diligent book. And if you look here, the lighter red dotted line in the middle of the bar chart on page 289, that's the IE objective 3 years from now. So the darker red dotted line at the bottom, that's the IE objective, what the fund value would need to maintain in order to maintain the economic value of the fund distribution today. In 3 years, once you now have a higher distribution rate, and that middle line, you now have a much higher objective, a higher bar that we will see within that 3-year period once that average is higher. And you'll notice that that middle blue line, which represents the 50th percentile for fund growth, that no longer keeps up in the long term with that 3-year forward-looking average. And that's because, just like we talked about in the inflow analysis, we're getting big contributions into the funds today. But after that 5-year average catches up, we're not expecting very many contributions into that fund in the future, absent something else happening. And so therefore, it's going to be a lot harder to maintain that objective because we won't be looking at very much in contributions. We'll be relying on investment earnings alone to both grow the fund and cover distributions to beneficiaries. So it's just something to keep in mind when you look at high scores right now, that may or may not be the case when we look at these scores into the future, particularly for early childhood and those increased distributions. So that was quite a bit. I'm just going to summarize for us here. There's 4 key takeaways from this year's report. The first one, that the score is simply a probability of maintaining the inflation-adjusted value of the benefits from the fund. The second is that a high score, which we see in this report, indicates a high probability of achieving that objective, and that's largely because these inflow projections are higher than in the past, and in the case of, say, the severance tax fund, that's because the fund itself is simply receiving brand new sources of revenue. The third thing is that scores can change dramatically if the inflow outlook changes, so that's just important to keep in mind. And then the fourth and final point, or key takeaway from this report, is that the high IE scores that we see in this year's report are likely desirable, at least in the near to medium term, because they show a high probability of growing the value of future benefits, which is consistent with the recent signals from the legislature of a specific intent to grow distributions from our investment funds to help offset the risk of future oil and gas revenue decline. And with that, I am happy to stand for any questions.
So, Vince, when was the last time we had this? It was like 3 years ago.
Or 2 probably, but yeah.
Okay, so the percentages were like in the 60s.
We're in the 60s.
Yeah.
Mm-hmm. Right.
Okay, can we go back to page 275, where you have your definition? And, you know, appreciative of the sort of gist of what we're trying to do and where we're trying to go. But I have, still some, underlying concern that when we're so hyper-focused on future generations, do we ever look at what the cost of not funding current generations properly is? So it's weird that in our table that has the definitions of all of the probability percentages, that we use the word erode, talking about future generations versus today, but in the 51% to 100, we say benefits available to future generations is just greater than relative to current. Why do we use the word erode in one, and the other one is just greater than?
Madam Chair, I think that is a very fair point. And I think, I don't know, I might pass off the answer for that specific question to either Vince or to RDK, but I do want to make a point about, you're correct in terms of, there's a couple different ways to look at this. So that's why I wanted to spend a little time on the definition, what is the objective, and then what does the score mean? Because the interpretation is a way to interpret a probability. So let's say, for example, this score, again, it's just the probability of achieving the objective. It just means how likely are you to maintain the economic value of the fund, right? So if you have a less than 50% chance of doing that, then you could make a reasonable assertion to say, in the future, the value of these funds are less than 50% likely. They're unlikely or less likely to be able to maintain their current value. That means it's going to decline. If it can't maintain its value, then in the future, relative to today, the economic power, spending power of those benefits will be smaller versus how much you can get with those same dollars today on an inflation-adjusted basis. If it's more than 50%, then you're saying it's likely. It's much more likely or highly likely, depending on how far up that 50 to 100 you get, that the economic value, the spending power of that distribution today and in the future will be relatively the same. So if it's very, very likely that that spending power will be maintained, then you can also interpret that it's likely to grow, right? Because if you're just at 50%, then you're just likely to keep it flat. So if you're high, it's likely to increase in value. If it's low, it's likely to decrease in value. But that's again why the score itself is less of the focus than is it directionally consistent with what the intended goal of the fund is. Now, I would not claim to know what the legislature intended, but I can discern what the legislature intends through the post-session reports, through the fiscal impact reports, et cetera. So like specifically for the severance tax permanent fund, there was a specific intent in depositing more dollars in that to say we're putting more dollars in this fund because we participated with LFC in conjunction with RESDEP to look at future distributions to the general fund, looking at oil and gas revenues. It's the same forecast that we use for this long-term inflow analysis, using similar assumptions for long-term assumptions in what the general fund gets in its oil and gas revenue. And they said, okay, what would it take? What kind of distributions would we need if, when we look at the declining input of oil and gas dollars into the general fund in the future, how much could you increase your permanent fund investment in order to make up that difference? So they essentially start to offset each other. That's not necessarily valuing future generations more than current generations. It's looking at the total picture to make sure that they're still equally weighted. Because right now, current generations are getting very large distributions of general fund oil and gas dollars, and this comparably relatively smaller permanent fund distribution. But in the future, they're going to get fewer general fund oil and gas dollars. And if we don't grow that distribution, even if the distribution was exactly the same, we're not on equal footing. Exactly.
So, and I appreciate everything that the legislature has done. I feel like sitting on this council, I have a slightly different objective, and that is not to sort of value some future buying power at the expense of, whatever we're funding currently. And really what I'm getting at is, what is the expense of not funding currently? Like, do we know what the cost is? Because we're not giving enough to, to the beneficiaries.
Far be it from me to speak on behalf of that, but I'll just make a couple of comments. In this last session, there was nearly $2.5 billion of new money for legislative funding, quite a bit of money in one-time funding that they had available for capital outlay, and then there were still additional dollars available. And there was a conscious decision to say, out of all of this excess money, what can you reasonably spend and deploy in a year's time? And what then, if you're not deploying it this year, what can you do with it so that it doesn't just sit on the shelf, right? And so that's when decisions were made to invest it. And, the way that I, again, look at this is not valuing future generations more or at the expense of current generations. It's trying to look at the total picture of where revenues are coming from And how do we keep this on a relatively equal footing? So not valuing future over current, but not current over future either. How do we keep this relatively balanced? And the picture is more than just the permanent funds. And recognizing that, we can see how can the permanent funds be used in conjunction with the other sources of funding, particularly for our beneficiaries, which in this case are our land grant beneficiaries and the general fund for the severance tax fund. Those are our beneficiaries. And how can we make sure that that is relatively stable so that when we do provide new programs in the state, that those can be funded well into the future. And I think that is more or less how I would look at it, but of course, I defer to Secretary Probst or anyone else who would like to make comments.
Madam Chair, just one comment toward that. From the council's perspective as being responsible for the management of the permanent funds, the distribution from the land grant is almost at the level that we think we can earn. So I think on 11th grade Charlie, we're 690. 610, and we can earn about 7 and a quarter. We've got to earn the distribution plus the rate of inflation to not have these funds go underwater from an economic standpoint. So from a distribution perspective, we're pretty
We're right there.
We're maxed out, yeah. So from the council's perspective of, being responsible for these funds, that's probably the first.
And perhaps my concerns are outside the scope of this council, but I continue to just wonder what we're leaving out of these analyses in terms of impact on who is here right now, what their opportunities are, what their access is, because because we're constantly looking to the future, it feels like, which, that's our job. And the second thing then I'll be quiet. I think that, increasing the royalty rate actually could go a long way towards impacting those, downturns that we're going to eventually see. Currently,
You think that's likely?
well, the legislature has to decide whether or not that's likely. So far, they have not. I'm just saying,
No, I
it's
understand
another
that.
tool in the toolbox. If we're talking about looking ahead, projecting that those revenues are going to take a downturn, we could be making more now to the tune of like 5% more.
Madam Chair,
Member Chair.
hopefully everyone can hear me, but I kind of share the same sentiments that the chair has with this study, and I do appreciate the thoroughness of the study. It is very impressive, and it's trying to capture a lot of different things that have happened, over a long period of time. So I have a lot of questions, but, I too worry that we're sort of pitting the current generation against future generations, and then folks are going to make decisions off of inequities and things like that are brought up through this kind of outlook on things. And I'm all for equity and keeping things within parity, but the one thing that really stands out to me is that we keep talking about the distribution rate, which is, as I understand it, constitutionally required. And we're focused on the rate, but we're not focused on the endowment, so the corpus and how much it's grown. Since I've been on the council over the last 3 years, I've seen the corpus grow from, what was it, 28 billion to now 40 billion. That affects a distribution. So, if you could just comment on that, because a 6% payout on a huger pie is much more of a benefit now than it was way back when. And then I don't know the level of analysis that was done on, just the value of $1 back in the 1950s as it compares to what it is today, and the level of the permanent fund back then. Then there's also all of these other questions that I have with respect to how technology has changed. And one of the reasons why, as I understand it, that the permanent funds have grown so much is because of the technology related to fracking and other things like that. So trying to put parity and equity on such an incredibly complex subject is worthwhile, definitely. I think it's something that we need to do, but we also need to be skeptical on looking at something that is this complex and making future decisions on that, right? So the other question I do have is related to the probability. How did you come up with assessing the probability? Did you use like a Monte Carlo kind of analysis, or what was that analysis that you kind of looked at?
Madam Chair, let me answer Nick's first question, and then we'll have Don hit the second one. On the first question of the big inflows, I would say what you're referencing is more or less a step change in the value of the funds. Step changes will affect both current and future generations equally, so we'll all see a higher distribution. As long as the fund, of course, in the interim, at least maintains its economic value. So the fact that the funds have grown well above what they need to grow.
Madam Chair, on that point, how do you assess that step change with like I said, going back to 1950s?
Well, if you're incorporating the inflation aspect, correct. So if you get a step change in the size of the fund, which I'd argue, and I think what I hear you're saying, that's what's happened. We've just seen huge inflows here, in that time frame. That affects everyone equally, assuming that the fund between those two time frames, from when the step change happens and then going forward, assuming the fund maintains its economic value, everyone benefits the same from that jump up in value. It's not a one generation or another when you get a step change like that. Everybody benefits roughly to the same degree.
But then at the same time, the payout on that is much more massive on 40. Well, I mean, it's not 40 billion because it's the two different permanent funds, but let's just say the number $40 billion. 6% on $40 billion is a lot more than it was on 28 billion just 4 or 5 years ago.
Right, and assuming that the fund maintains its economic value, say, for the next 20 years, those beneficiaries 20 years from now will also see a higher distribution by the amount of that step change. So everyone, it's just all boats rise with the tide in the case of a step change like that. For how we calculate, Don, you want to do that?
Actually, I'll turn it over to RVK for how it's calculated.
Yeah, it is exactly a stochastic analysis, as you described, using Monte Carlo simulation. So we run 10,000 paths and essentially see what the median path is in that experiment.
Thank you, Madam Chair.
So I hate to sound critical, but I'm very actually grateful for all of the work, and we printed this out as soon as I got this book, and I passed it on to my deputy, because it's literally the same sort of thinking we want to be having state land office, right? We want to ensure that there's, a future moving forward for maintaining what the beneficiaries get from the office. I mean, we are the influence.
Madam Chair, go to the legislature and get it.
You're going to come with me.
I will.
Absolutely, and there's no criticism taken from that. These simply are the scores that they are, and I think the other thing that I wanted to iterate is these are just probabilities of maintaining the value. So it's easy to maybe attribute additional interpretation to it, and you kind of can. But I would say that the interpretations on these probabilities are a little shakier than just the probability itself. There's an 86.2% chance of maintaining the economic value, which, if you're thinking in terms of like a pension-funded liability, if you are 100% funded for your pension, that's a good thing. If we were 100% there's a 100% chance that this value will at least stay the same, that it's going to maintain its value over time. You can try to discern different types of interpretations from those probabilities, but I do want to focus that it is just a probability. The other thing that I want to say, not on land grant, but particularly on severance tax, is the new source of funding that is in that. Now, whether we agree with the directive or not, whether you think it's the best thing or not, perfectly valid. However, because there are brand new, very large sources of dollars that have been put into that fund for the specific purpose of growing that distribution, if we saw a 50 come up on this score, that would tell us there's a problem. Something isn't working right, because it should be, not only should those additional inflows be maintaining that value, but there should be a signal that it's going to grow that value because that new money is being put in. So this is, again, just a tool in a toolbox to say, is this directionally going where it should? Is it meeting those funds, the goals of the fund? You know, if we saw less
or
of
the
this,
intended consequences of those legislative
exactly.
actions. So are you going to present in front of the legislature?
I'm sure at some point either IPOC or RESTEP will ask us to present. I think RESTEP has a plan to have us present on the effects of Senate Bill 26, again in conjunction with LFC. We presented at RESTEP's request last October to RESTEP, where they were looking specifically at this issue. They presented us with a bunch of different scenarios and said, will you please run this what-if analysis? And the point of that was to say, okay, if we look at future oil and gas revenue, what kind of distribution, what kind of money would you need deposited into this fund so that the future would roughly even out the expected decline? And that's actually where the premise of Senate Bill 26 came, was out of that presentation to RESTEP. So we'll be following up on that, I'm sure, at some point later this year.
Good stuff. Good stuff. So glad you're at the SIC, even if it's just on loan. Don, she's there for real? She's there for real?
She's there for real.
Thank you.
Yes, Don, that was amazing, Don.
Madam Chair,
Yes.
does Texas get a larger?
Yes, Texas,
Yeah,
yes.
I know. We
Thank you
need
for
to
that
match
softball
it.
question. Texas gets a higher royalty rate.
Yes.
The private mineral owners get higher royalty rates than the state does, because they're able to negotiate those independently with oil and gas producers, and the state is held by our statutory. Okay.
We need to change that.
So we have our last report, and we're going to hear on agenda item 3K, fixed income public market short duration high yield RFP.
Thank you, Madam Chair. So this is a informational item, and it's a follow-up action item from the March fixed income structure study. So SIC staff, with support from RVK, will be issuing a request for proposal for one or more active investment managers to manage a liquid, short-duration, high-yield fixed income strategy for a portion of the short-duration pool of the public fixed income allocation. The RFP documents will specify the minimum requirements, and the evaluation and selection process are detailed in the informational memo.
On page 760.
768, Ms. Mayor.
Question? Move on to agenda item, thank you. Agenda item 5, moving matters, any old or new business for the hearing? None. SIC meeting, remember have a recess in the July month, so we'll meet next on August 29th, Tuesday, in Santa Fe. Now we're going to head to public comment, Charlie.
Don't believe we have anything.
Hearing none, then we'll move to adjourn. Is there a motion to adjourn?
So moved.
Okay, we've got a motion by member Messina.
Second.
Second by member Summer. Any objection to an adjournment motion?